just for today. All right, let's find that one. Okay. That's my lecture 8. Okay. Oh, well, this is good. That's, I think ahead. Weekday traditionally when assignments are due is when we tend to get fewer people in class. So ordinarily during the week 8 seminar and the foreign exchange seminar, we do exam revision because it's a way of rewarding the people that come here. So that's what we're going to do today. We're going to do this, and then we're going to do some exam style questions, exam papers. Yes. So that's good. It was worth you guys coming today. So today is very, very short relative to all of the other weeks. We've only got 40 odd slides, so it should take around an hour. We'll then spend the subsequent 2 hours doing exam preparation. All right, preparing for exam style questions. I'll talk to you also about your simulation that's coming up this week as well. And thank you all for completing the assessment on time and coming to class. All right? If history's any guide, you guys will... if history... I forgot myself for a moment, my sincerest apologies. If history is any guide, the people within this room will do best within that final assessment. So look, Nathan, you're included in that group, so it's the attending group. So the Forex topic is an interesting one. We did devote far more attention to it in the past, but because we have a devoted international finance unit, and we have a full derivatives unit now, this becomes the introduction to those two units. So we focus in particular on euro market transactions and market conventions. All right? There are two key focuses. All right, when it comes to your final assessment, your final examination, the only category that you really do need to focus on from this seminar will be that euro markets discussion and those core conventions. We do discuss a number of other things. You'll be introduced to the pink slips market, you'll be introduced to ADRs, two very interesting North American markets that we're now seeing crop up as alternative markets for securities selling and delivery. Other contexts, but again, that is more for knowledge's sake than anything else. So the Forex market is undeniably the largest in terms of market turnover. When you're looking at markets and you're discussing the nature of markets, this is undeniably the most significant in terms of turnover. So when you look at it, you're talking about $2 trillion a day. Okay, it's quite substantial. Why? Because all trade and commerce is facilitated through the Forex markets for all intents and purposes. When a transaction is initiated in one context and completed in another, there is going to be some sort of Forex conveyance between one entity and another. For that to be possible, there needs to be some Forex translation. At different points in history, your ability to translate currency has been markedly different to today. Undeniably, during the early part of the last century, notwithstanding technology, the trade of currency was largely unabated. And as a result of conflicts and non-conflicts between certain countries, the transference of currency between certain jurisdictions was restricted heavily. And interestingly, in modern times now, we're seeing countries enact capital restrictions again. And this is for a number of reasons. The most obvious of which is that many countries that have poor performing currencies are concerned about the rapid decline in their currency position and are restricting the movement of capital. Others simply don't want too much capital flowing abroad because it results in a diminution of available capital within the local market. Let's consider a couple of examples that reflect this. The first and most logical would be, at present, Argentina. Argentina is genuinely concerned about the flight of capital and, as a consequence, heavily restrict the movement of money. But equally, in China and India, there are restrictions placed on the amount of money that you can shift abroad. This has resulted in a number of grey markets activities in the context of China, happening through conduit markets like Hong Kong and Singapore. And in the context of India, a number of grey markets actions happening through familial associations abroad. But in saying that, those policies probably have helped both of those markets encourage domestic capital market investment. All right, how does our market differ?
Ours, the Australian market, is a truly unabated market. It's a remarkably popular market. In fact, it's been, at worst, the 6th most popularly traded currency in the world. And there are a number of reasons for this. Our nation presents a number of worthwhile investment opportunities. So our domestic capital markets are very, very appealing. They represent just over 3% of global equity. That is substantial when you think about the number of economies that exist in the world. Beyond that, there is huge interest in Australian debt markets. Even if it doesn't come from domestic investor groups, foreign investor groups have a strong appetite for Australian debt. And arguably one of the most important, albeit conditional drivers, is the performance of commodities. Okay? When commodities markets soften, in particular, our currency becomes even more appealing in the short term, as there is a flight to commodities markets with a view to those markets improving again. So the Australian currency is a popular one. We like to use the expression, we punch above our weight a lot in this country, but it is very true of so many things that we do. All right? It's kind of remarkable to think that we are so popular when it comes to international investment. When it comes to understanding how the markets work, it's important to appreciate that there are a number of key players. Most of your interactions with markets have been, I should say, through retail market participants. But the reality is, the vast majority of market movement is the consequence of the actions of dealers and brokers, and central banking activity in particular. They tend to drive movement within the market. There are people, however, that can influence currency positions by virtue of their position and the capital that they represent. There are a number of people that are betting against the Australian currency and have done so for some time. Whether they can maintain their position and the gains that they're making in the long term is uncertain. You guys are probably aware of the fact that several years ago, our currency approached parity with the US dollar. Does everyone remember that time in history? Yeah, our currency was actually close to parity with the US dollar. It wasn't since a number of decades prior to that that we saw such close to parity conditions. And the reason for that was because our credit metrics were so good. We have exemplary credit metrics in this country, probably the 3rd best in the entire OECD. Okay? So when you're looking at the entire OECD, we rank 3rd. Okay? Okay, so generally South Korea's credit metrics are better than ours, and from time to time, albeit this can be a little bit varied, there have been certain points in history where the US and the UK have been ahead of us. Okay, at this point in history, that's conjecturable. It really depends on the interpretation. I would offer that we're probably second at this point. There aren't too many other, really, really well-performed OECD countries. So, yeah, very, very good case in point when comparing the performance of our economy relative to others. Again, something to be very mindful of when looking at our markets relative to others is that we do have a lot of assurity that comes from our commodities segment. Right? It brings a lot of assurity to our currency. Unlike many other economies that, for all intents and purposes, might be described as commodity currencies, we have been stable even when commodities prices have softened. All right, but again, returning to that discussion of why we're no longer at parity, a number of people bet against us. All right, there are a number of very substantial institutional players that bet against the AUD, and to an extent, their narrative within the market, it made the outcome almost a self-fulfilling prophecy. I would offer that our credit metrics are still probably better than the US credit metrics. And the reason that the US position perhaps has been as stable as it has is because of a program we're not prepared to support. And that's a credit easing program. So the US government has decided that they want to engage in a broad-based program of credit easing, and they've continued to do that. So that was supposed to have been discontinued a number of years ago. All right? And we saw a rapid decline in our currency post the decision of 2 administrations to maintain that program. All right, so the market obviously felt that that program was quite compelling. Okay? That program of buying private sector assets to prop up the economy. So we've declined substantially as a consequence, but again, our currency has been reasonably well performed. Notwithstanding that decline, it's been relatively stable. Prior to the the enactment, the employment of a free-flowing currency model. In the 1970s in this country, we actually had a fixed currency regime in place, whereby an Australian dollar could be exchanged for a fixed amount of US currency. And in fact, that amount was greater than $1. We moved away from that model because that model is unsustainable in the long term. Unless you have an unlimited supply of capital reserves, you can't do that into perpetuity. Unless of course, maybe you're China or India, and you've got a good amount of ongoing capital flowing into your market such that you can maintain a program like that. And even with those economies, there will likely come a point in time in history where they struggle to maintain those currency positions as well. All right, so your interactions, as I've mentioned, has probably largely been with retail market participants, but there are a number of other key players as well. Foreign currency speculators and arbitrators increasingly can influence markets quite substantially by virtue of the sentiment that can derive from subtle shifts in market performance. All right, it's much easier for smaller groups of investors to influence outcomes than perhaps it was previously. But undeniably, central banks and FX dealers and brokers are the key participants. It's really remarkable actually tracking foreign currency data. If you ever get a moment, you know, in our programs to access a Bloomberg desk or a Reuters desk and just sort of sitting at it and looking at the transactional matching and the transactional flow, it's kind of remarkable just how quickly and efficiently transactions are matched and how voluminous the transactions now are. The one intriguing thing that you do note is that there are a whole heap of market takers and a handful of very influential market makers, very substantial institutional banks that influence positions substantially. All right, how do we differentiate between speculators and arbitrators? Has anyone heard that expression before? What is arbitrage? How does arbitrage differ from speculation? You know, in finance textbooks they teach you about arbitrage transacting all the time, like it's this really easy thing to do. You know, you sit at your desk, market mispricing, let's jump in. The reality is there's a little bit more to it than that. It's hard to identify arbitrage opportunities. So arbitrage is essentially generating a gain without taking on any risk. It's a riskless gain. And how do you generate arbitrage opportunities in the context of financial markets? Well, you identify market mispricings. So frequently, you'll have currencies maintaining a particular rate of exchange in one context and a different rate of exchange in another. That's referred to as geographic arbitrage. If, for argument's sake, there is a market mispricing that involves three currencies, we refer to that as triangular arbitrage. And that's one of the most common arbitrage opportunities. You'll find that most geographic arbitrage opportunities are not true arbitrage opportunities because they involve some transactional cost, which offsets the arbitrage opportunity more often than not. But geographic arbitrage opportunities do exist from time to time, and certainly triangular arbitrage opportunities do as well. When you go into MAF 760, those of you that will take that subject with me in the future will learn about multi-point arbitrage and multi-market arbitrage. All right? Will be exchange 7 currencies or 12 currencies to generate a gain. All right? I'm not a huge fan of currency markets, I'll concede. I don't believe that people should be making money engaging in transacting where there's no value benefit to anyone, but obviously this is something that people do very, very popularly. People devote themselves to it. I have a friend that runs the ANZ currency desk, you know, and he literally just sits there managing a team, and this is what they do. You know, they have the suitable number of computer screens in front of them, and I'll concede they generally have computers directing most of their decision making. You have to be lucidly aware of that. Even though the law precludes you from engaging in an automated trading framework, everyone's aware of that, right? You can't use automated trading frameworks. They're lawful, unlawful everywhere in the world. They're not lawful here either. Even though you can't do that, the reality is people's decision making is still directed by modern technology. Okay, you might have heard of the expression of a trading bot. You heard that expression before? Yeah? So a trading bot, for all intents and purposes, is a simple algorithmic framework that's created to execute a buy or sell position call based on a set of criteria or indicia being addressed. All right? Things are getting much more complicated than that now, though. Okay? We don't talk about this too much, and you'll probably never talk about this again in any academic program, unless it's one involving myself or anyone else from a markets background. And that's high-frequency trading. It's a real thing, and it is happening, and it makes trading activity very, very problematic. It's really quirky, though, because both academics and people in industry use the following expression. It's not a very significant activity because it represents between 25 and 35% of volume. Does that not sound like the most absurd thing you've ever heard? 25 to 35% of market volume is now high frequency, particularly when in equities markets. Less so in this market. Okay, this market can waver quite a bit. When it comes to Forex, you might see spikes where there's substantial activity, but the average levels, I'll concede, are lower. But increasingly, high-frequency trading is influencing the activities of market participants. Does anyone know what high-frequency trading actually is? Has anyone actually kind of explained that? Okay? It's a cool-sounding expression, isn't it? High-frequency trading. Sounds like someone that's just more efficient than everyone else. Yep.
It's essentially an algorithm that's basically setting the parameters that anything that's
Yeah, to an extent, yes and no. There are various layers to a high-frequency trading strategy. But one of the smartest strategies involves entering into the market with various points of entry. All right? It's a mapping strategy. People that are executing these strategies smartly are endeavoring to map markets quickly and engage with the market such that they can garner what the appetite for the market is for different transactions at different levels. So think about taking the following approach. As a trader, you can enter into a trade based on your knowledge of the market and your desire to facilitate a particular transactional outcome. Let's say I want to trade $100,000 for something else. All right? I can facilitate the trade. Or I can determine whether there's a greater value gain opportunity by executing a very substantial number of micro trades very, very quickly. All right? 100,000 of them. Let's say I try to facilitate 100,000 low-value trades. Okay, very, very quickly. What can I do? I can very quickly initiate the trade and close the trade off. Okay? So I can open up a huge number of trade positions and then close them. Okay? But before I close them all, some of them will be captured. Some of them will actually be matched. And what do I then have? I then have a really accurate capture of that point in time of the appetite for the market for different transactional positions. So what am I going to do? I'm going to execute a trade at the most viable position that was consummated through that high-frequency action. So it's kind of an unfair advantage because you get a huge map of the point history in that market very, very quickly, and then you can execute subsequent trades. And most of your trades aren't going to be consummated, so it's not really costing you much. It's costing you very, very little, if anything. It's likely to not be costing you anything because you'll have some low and high value trades, some that result in a gain and some that result in a very minuscule loss. Okay? So high frequency traders, they do this. And in the equities markets, they can quite literally release, for argument's sake, 10,000 different trade point positions and very quickly map an equities market that exhibits less volume than this. And so in an equities market, it's even more valuable insight. Technically, it's unlawful, all right? And there are ways that, people are trying to track this sort of activity. So people like myself are trying to look at how AI can be used to actually track all of those transactions and figure out which are high-frequency transactions and which are non-high-frequency transactions. But the reality is it does make things problematic for your everyday trader because you're now having to compete with people that have a broader map of the market's interest than you do. So you have to be very, very intelligent when it comes to trading. Either be very, very good with your foundational analysis, or you need to somehow garner similar information in a lawful way. Okay? You can use historic price information, and you can build AI-driven models that can enhance your decision processes as well. That's completely lawful. It's completely lawful. What's unlawful is entering into trade positions just to generate market information with no desire for the consummation of that trade. Very hard thing to prove, though. Okay, very challenging to prove. All right, so high-frequency trading will increasingly influence market positions. It will make it harder for individuals to compete with non-human operators. All right, let's consider the roles of the different individuals within this market. We have FX dealers and FX brokers. FX dealers are financial institutions, generally commercial banks and investment banks. These are the market makers, and they provide two-way quotes. Okay? They provide two-way quotes, and they're normally licensed by the central bank of the countries within which they operate. Okay? Within Australia, we don't provide the central bank with that deference, that licensing capability. It all happens through our securities regulators. All right. When it comes to FX brokers, they transact almost exclusively with dealers. They identify to match, buy and sell quotations. So these are individuals that operate at that next tier. I dare say you could start a firm that engages in brokerage if you wanted to. You could essentially see one position that's open and another position that's open and match them and generate a return on that basis. So for all intents and purposes, it's a matching exercise. All right? All right. Central banks enter into the market for a number of different reasons. They purchase foreign currency to pay for imports, and they also seek to pay interest or redeem government-related debt. They also engage with markets for, again, for lack of a better description, for a number of compliance-related reasons as well. They might, for argument's sake, want to maintain a particular complexion or pool of currencies, of different currency values and different currency types. Perhaps compliance is an overstatement. I'll describe it in the following way. They have certain internal targeting rules that they want to address. So the rules in many countries have changed in recent years. You would come to discover, quite logically, and I think quite reasonably, that for the most part, the vast majority of international participants had an interest in which currency for a very, very long time. Which currency did most central banks want to carry? US dollars. Okay? They wanted to carry substantial quantums of US dollars because that was the currency of last resort. Makes things very hard for the US economy, to be honest. That attitude, that mindset makes it very hard for the US economy. I mean, they do remarkably well considering that their currency is the currency of last resort. It's never allowed to strategically or structurally devalue such that they can gain an advantage again. It's always been a challenge for their manufacturing sector. It's amazing that they can have these recurrent waves of manufacturing in that country in light of that. One thing that has made it a little bit easier from the US has been the emergence of the euro. Okay, so the euro for a number of years became quite popular, and a number of countries and economies started carrying substantial quantums of euros, which resulted in both stability in the euro and also an appreciation of the euro relative to the USD. Things have changed a bit now, and China and India in particular now like to hold a very diverse portfolio of currencies, and they hold very substantial quantums of Australian assets as well. Okay? So you'll find that between China and India, you'll see at least 10 to 15% of all Australian government securities held. Okay, so they're quite literally the major debt holder when it comes to Australian securities, China and India. They endeavour to now hold a representative market basket of currencies based on their trade partners. That's their goal. All right, so why do you engage with the foreign currency market? Well, again, not wanting to insult anyone's intelligence, I know that you know this, but we'll just talk about it briefly. The most logical reasons relate to both exportation and importation. How are you going? So exporters want to receive currency for the sale of their goods. Importers want to facilitate the purchase of goods. And the position of your currency has a dramatic impact on your ability to do so. We in Australia have had a very strong currency for a very long time. It's made things very challenging for our manufacturing sector. I used to work in the Australian automotive sector. The performance of our currency made our vehicles very, very expensive abroad, We did have export programs in place with the US and with a number of Middle Eastern countries. But again, it was always a challenge just by virtue of the currency position. Obviously, manufacturing a vehicle in Korea relative to manufacturing a vehicle in Australia, there are going to be major differences in terms of being able to facilitate a particular price outcome. So that's something to be mindful of. Obviously, when it comes to importation, a strong currency makes importing very, very popular. So the strong Australian dollar encourages us to acquire many foreign goods. We have a strong appetite for foreign goods. But interestingly, so do some countries that have had quite a varied currency position as well. So this does not always moderate the performance of your import segment. Interestingly, in India and China, they have a very strong appetite for foreign goods. China, in particular, has a very, very strong appetite for goods from the West, notwithstanding the fact that it's cheaper to buy high-quality Chinese goods than it is to buy North American goods. It's just an interesting cultural quirk. In India, things have evolved a little bit differently. India has a very substantial domestic manufacturing market. The vast majority of India's manufacturing facilitates and satisfies the needs, I should say, of local market participants. So in India, there's a strong interstate level of trade. Within China, the vast majority of manufacturing goes abroad, and there's a strong desire for foreign goods, which I don't. Again, I wonder about. Why is that? Anyone that's from that context? Any reasons why? Because I think Chinese goods are really high quality now. Personally, the standard of manufacturing in China, I think, is exemplary now, for the most part. But it's just interesting. There's a real desire for foreign brands. Sorry? Perhaps, but it's just, I don't know. It'd be like buying an Xbox in Japan. Like, it wouldn't make any sense, you know? Like, you make PlayStations. They're very cheap there. You know, it's one of the few markets in the world where Xboxes are heavily discounted because there's a local manufacturing program in place in relation to a local good. Like, you have, you know, Meizu, you have M1, and so many good manufacturing groups. Anyway, that aside, yes, there are some non-consistent quirks to certain markets that have an appetite for foreign goods, but for the most part, the position of your currency is the most significant moderating factor. And I think when you're talking about currency and its impact on economies, India and China are really good examples because they've moved in such different directions. Okay? In India's case, it's resulted in a substantial amount of domestic manufacturing for the domestic market. In China, it's resulted in a substantial amount of foreign manufacturing, but with a strong desire for Western goods nonetheless. All right. Why do investors engage with the forex market in the context of debt and capital transactions? Well, commercial banks are going to need to facilitate exchanges back to a domestic currency. Corporations are obviously going to be investing abroad substantially, and they're going to need forex to do that. And so every time a bank engages with an international market in the context of an international market transaction, it's going to be supported by a forex-related exchange. Do you know what's really interesting about banks is that they don't actually facilitate their own forex transactions. Are you guys aware of that? Who facilitates forex exchanges for the major banks? Does anyone know? Does anyone do any transfers back home from here or vice versa? Sorry? Well, interestingly, there are a number of intermediaries that integrate with the SWIFT system. Have you guys heard of the SWIFT system? Yeah? The SWIFT system? So our major banks, for example, they use these third-party service providers to facilitate their foreign exchange transactions. Okay? Has anyone noticed that? Because there's a particular document that you need to fill out, and you pay a fee. And it's hard to get them to waive that fee. Anyone notice that when you ask them if they're going to waive that fee? Why do you think they don't waive that fee? I used to get them to when I used to work on certain projects that were of philanthropic nature. I'd be like, come on guys, you shouldn't be charging these fees. But the reality is that there was a reason internally why they would have a standard position of not reversing that fee. And that was because they don't facilitate that EDI. They don't facilitate that exchange. A third-party provider does. The major banks don't do that. Okay? They work with third-party vendors to facilitate the vast majority of their foreign activity. All right. Fine, we're going to talk briefly about the notion of speculation. I'll concede that people love speculating on currency. Okay, I have a far more interest in early stage investment and emerging markets investment, but this is one of those markets that I think attracts people of all shapes, from all backgrounds, because they see it as an opportunity to garner substantial gains. And yes, if you are good at it, you can garner substantial gains. I've had many students who I've engaged with, who over the years have paid for their study and subsequently paid for their time in the country doing just this. But it's a very challenging market, particularly now. Okay, it's very, very challenging in light of who's participating within the market and how they're participating. So what is a speculator actually doing? A speculator is taking a formal position in relation to a particular currency with a view to that currency appreciating or depreciating. Okay? There's been rampant speculation in recent years in relation to the Australian dollar, with the vast majority of people betting against it. A number of major international funds have talked about the fact that they felt that our performance was overstated. It's quite funny that there are no rules in place to make that kind of action unlawful. All right? If you were to do that on national television in relation to equities or any debt-based security, okay, you would be in breach of the securities legislation. But when you talk about Forex, you're not really breaching any laws, are you? Because no one can sanction you because it's an international market. And so you'll find that a huge number of players within this context have endeavoured to influence the market, particularly against the performance of the AUD. And undeniably, yes, they've won. We've seen the currency decline from around 94, which was a high of a couple of years ago, to its current position. Does anyone know where the dollar is at present? Yeah, so we kind of waver from, at best around 76 to at times 68, 69. That tends to be where we sort of track. But the reality is our credit metrics are better than that. So it's interesting. It is interesting that we are performing so poorly relative to the US, given that our credit metrics are so good. I think one potential trigger, and again, this is both the Chatham House rules and my advice is of a general nature situation, when we see a reversal of the quantitative easing program, you might see a very, very substantial shift in mindset and in sentiment in relation to ours relative to the relative to the USD. Triggers are very, very important when it comes to markets. This market is still a very behavioural one. All right, so we're now going to talk about those two categories of arbitrage opportunity. We're going to introduce the notion of geographic arbitrage and triangular arbitrage. Okay? Geographic arbitrage and triangular arbitrage. So we'll start with a triangular arbitrage scenario. The geographic one is rather obvious. A market mispricing in two contexts, essentially the same quotation of currency pairing, but with a different value attaching, is the standard geographic scenario. The triangular arbitrage scenario warrants a little bit of additional attention. This is a very simple example. All right, the real world isn't this neat, okay? But this is a nice, neat example just to, how do I put it, convey what we're endeavouring to talk about. So we'll start with a simple one involving one USD and its equivalent value at AUD, one USD and its equivalent value in Singaporean, and then a mispricing in relation to the AUD and Singaporean dollar. Okay? So please pay particular attention to the sequence of steps, in particular the starting currency. All right? Always take the perspective of an Australian person when doing something like this. That's your starting point in terms of mindset. Okay, what would someone in Australia need to do to benefit? All right, so given the market mispricing, we start with the underpriced currency and we move into the currency That is the common currency. Okay, so I'm trying to create a rule for you, if there was one. Okay, so underpriced currency to the common currency, and then to the relatively overpriced currency. So one AUD should actually be worth what? It should be worth 1 Singaporean, but it's not. All right, so we start at an AUD, we go to a US dollar, we then go from a US to a Singaporean, and then we return to an AUD. And we keep doing it, rinse and repeat until you can't do it anymore. Okay? That's a really simple arbitrage strategy. More often than not, though, when identifying arbitrage opportunities, it's really hard to see very, very obvious ones. So what we do quite frequently is we run a multi-point arbitrage calculation. And so we might look at 7 currencies concurrently and multiply them out across all pairings and figure out whether there's any sort of basis gain or arbitrage opportunity. All right, and so when you go to the advanced subject, we actually do all of these calculations in Excel. All right, you actually figure out how you can run the analysis on the numbers. At this stage, you just need to understand the logic behind the calculation and how you would shift from one currency to another. Okay? So this is an important thing. Okay. All right, so the Forex market, I think, is a very unique one, and it attracts a unique set of people in particular. I think you have to be very gung-ho to operate in this market because it does involve substantial risk. So all of my colleagues that operate on trading desks, they need to have open positions, overnight or frequently if they're working on a desk where the time frame is different in terms of the hours of trade of that desk. They'll have open positions when they're not at the desk. All right, so how do you moderate that risk? Well, obviously you have people working around the clock. Every major bank will have people on that desk around the clock. Okay, the lead staff will generally be on when the hours of trade of that particular currency pairing of focus are actively traded in particular. Okay, so this is true of most of the major currencies. Obviously, with minor currencies, minor currency activity is handled by a collectivity of people. But the major currencies normally have teams. Okay? Specific currency teams or currency units that handle a specific portfolio of currencies. And so, look, you can go to bed, for example, and have a particular position and it not really work in your favor while you've been asleep and wake up to a very different position. But, as I said, that's not really true of the way modern operations are moderated. You now have people working for you to moderate these positions while you're not there. But as I said, I do still feel like the category of individuals that operates here is a very, very, how do I put it, risk-taking type of individual, or indeed, at the very least, not a risk-averse person. Okay, we're just now going to go through some market conventions now, okay? Okay, these are the two most common ones, spot and forward. So you'll see these words used a lot. A spot transaction has a maturity date of 2 business days after the transaction is entered into. So if someone talks to you about a spot transaction, they're talking to you about a transaction that is T plus 2. T plus 2. Transaction point plus 2 days. A forward transaction is any transaction that is greater than T plus 2. So a spot is T plus 2, a forward is greater than T plus 2. So when you're looking at spot transactions or forward transactions in the context of your accounting class, you might be looking at FRAs, or if you're doing a later finance class, you might be looking at structuring rate agreements or valuing rate agreements rather than accounting for them. That's what the words are referring to. That's what the word is trying to convey to you. Essentially, a spot transaction is T plus 2, forward transaction greater than T plus 2. In addition, we also have Todd and Tom transactions. No one really people don't use those expressions as much. Okay, but a Todd transaction is a transaction that is entered into today and completed today. A Tom transaction is a today plus 1 transaction. And obviously we then have spot and forward. Okay, so Todd, Tom, spot, and forward. For those of you that are interested in this, there are 3 chapters in the textbook on Forex and advanced Forex concepts. For those of you that are wanting to know what the core understanding is in the context of this course, just these notes. Okay? But I encourage you, if you are interested in this, there's a lot of material available. It's obviously one of the oldest markets. So there's been lots of discussion and conjecture for a long time. Okay, so spot market quotations. Here is where things get a little bit interesting. All right? There are a handful of textbooks in the world that reverse this convention. Okay? What I'm going to tell you right now is that those books are wrong. So I will get email this evening from people saying, I've learnt this differently. Well, I'm trying to be very kind in conveying what I'm about to convey. Someone has taught it to you the wrong way. All right? It does happen. The reason you'll find these conventions are reversed is because reversing them makes the maths a little bit easier sometimes. And so you'll find that people don't meet the standard. But why is it wrong? Because we have an international ISO standard around financial market conventions. ISO 1072 from memory. All right, so you can look it up. So I'm not lying to you, so please don't email me. All right, because I can't tell you why Pearson publishes that book. Maybe because the editor that's in charge doesn't know anything about finance. All right, and it's used in a class at Deakin. It's also used in a class at Monash, and it's used in a class at La Trobe as well, for some very odd reason. It's like no one's bothered to read it. They've just said, we need a book that has the word finance on the front, and this will do. It's also one of the reasons that I am not using any of those books. So, very, very important. There is a right and a wrong way when it comes to market conventions, 100%. Okay? First and foremost, you have a quotation involving a currency pairing. Your first currency in the quotation is your base currency. The second currency in the quotation is your terms currency. First currency is base currency, second currency is terms currency. That's always the way that it is. It does not change. Some people do get confused from time to time, and there are some correct textbooks that will change perspective in a given question. Because obviously, if you were to look at a transaction from the perspective of one person in one country relative to another person in another, they would have reversed perspectives. But you always need to be taking the view that you're the domestic individual, okay, in the context that you're operating in when looking at a question. Okay, so that's an important thing to remember. So in this case, we have the euro quoted in terms of the AUD. There is one quirk to our market relative to many others, I will concede. Okay? We like indirect quotations in Australia. And I think that's completely logical. Okay, maybe that's my bias showing, but that's our preference. Within our financial press, you'll always see indirect quotations. Within many other markets in the world, they prefer direct quotations. They like to see other currencies quoted in their currency. All right? But that's still equally correct. The base currency is still the first, the terms currency is still the second. Nothing changes in that regard. Okay, so what do these numbers actually mean? Well, you have the euro AUD as 1.6155 to 1.6165. Okay, and we normally abbreviate by dropping two numbers, just to expedite communication. Okay, so you would probably say something to the effect of it, the quotation being 6155 to 65. Everyone can assume away that first number, and in truth, quite frequently when you're very active in the market, you'll just be talking in the last two digits. So you'll be saying 55 to 65. Okay? What does it actually mean? The first few times you interact with currency, it can be a little bit confusing. First few times you do a cross-rate calculation, it can be a little bit confusing. All right, so bear that in mind. But the first number, okay, is the number at which the dealer will buy a euro. He's always going to buy it. This is the easiest way to never make a mistake. You can never make money when interacting with a dealer. He's always going to buy it for the lower number and sell it to you for the higher number. If you want to forget about all of the conventions, you can just think about it that way. It's always going to sell it to you for the higher number, buy it from you from the lower number. Okay. Okay, so that's something to be mindful of. Base currency, terms currency. €1 in terms of the AUD. You will note the following though. You will rarely see a number after the base currency. Technically, you can put a number there and it's equally correct. You could put a 1 there if you wanted to. But most people just drop that. You'll rarely see anyone ever do that in the real world when you see a quotation. But technically, there is a 1 there. It's €1, AUD 1.6155 to 1.6165. Okay? So with two-way quotations, this is how we calculate our spread. The spread is essentially the gain to the dealer for all intents and purposes. You have your offer price and you have your bid price, divided by your bid price, multiplied by 100, just so we have a nice neat number at the end. Okay, we're going to do some rate transposition now. Okay? What I'm going to do is give you a couple of rules that will ensure that you don't make a mistake. But I want you to understand the logic as well. Okay? So we're going to focus on ensuring that we don't make a mistake and also the underlying logic concurrently. So here we have that same quotation, 1.6155 to 65. How do we now find the reversed quotation if we want to go to AUD euro? Okay? Well, simple rule, we just reverse and invert. Okay? Some people get confused by that notion of reversing. Again, just think about it this way. The dealer needs to buy for the lower number and sell for the higher number. Okay? So reverse and then invert. Nice and straightforward. Very easy. Okay? Calculating cross rates can be a little bit more problematic, and I'll concede that in the modern world you don't really do this that much anymore because you have a desk in front of you and there's a computer on the desk and the computer gives you the information, but it's important to figure out how those figures are derived. There are some currencies that are not heavily traded against others. Okay? We in Australia are really lucky. We have a really popular currency. But let's say, for argument's sake, you were trying to compare, I don't know, two less popularly traded South Asian currencies. Okay? So that would be challenging. Or for argument's sake, a currency from a lower population Middle Eastern nation with a lower population Latin American country. There's not going to be a substantial amount of volume. Okay? So those currencies will all derive their quotation from their relative value against the US dollar. Okay? Because they will be popularly traded against the US, because everything is. So what we do is we take their USD quotation, and then we calculate what we would describe as the equivalent rate or the cross rate or the calculated transposed rate, any number of ways to describe it, based on how they perform relative to the US. Okay? So this is not really one that you would need to do in the real world. We're just running with some currencies that you're familiar with. Okay, so the euro is pretty popularly traded. So is the yen. Okay? But let's say, for argument's sake, you wanted to calculate the equivalent cross rate. How would you go about doing it? Okay? Let's consider that now. So, I'm going to give you a rule. I would encourage you to use this rule in this subject and every other, because you will do this calculation a lot. Okay? When you have a common base currency, you can see that the matching is cross-rate division. Okay? When you have a common base currency, you match through cross-rate division. Okay? To be honest with you, that's really the only rule that you need. Because if you see any other set of quotations, why not make the base currency common? and remember one rule. Okay, students get into difficulty when they try to remember every single iteration. When you have common base, when you have base terms, and then you have common terms. All right? It can be a little bit confusing. This way it's quite straightforward. It's cross-rate division. To put it another way, we're matching bid to offer and bid to offer. Does that make sense? 105.40 is matched to 7655, bid to offer. And then I have 10550 is matched to 0.7650, bid to offer. Couple of things. When you're doing a calculation, you'll know if you've done it wrong. If I'm doing a yen calculation to a euro, clearly here I can see in common terms that units of yen are worth less than units of euro. So my answer must reflect that. Okay? Okay. Okay. What if you have a common base and terms currency? Well, the fastest way to get your answer is through multiplication. Okay? So the fastest way will be to multiply the values one against the other. So you can see on this occasion, the reason it's reversed, think about why it's reversed. Okay? It's reversed because in the earlier example, I was dividing one by the other. Now, because they're reversed, the opposite of division is multiplication, and the positions have been reversed, so I need to multiply. Got to think about it mathematically. Okay? Reversed positions. Okay? The bottom two have been reversed. Right? The bottom two have been reversed. So now rather than doing cross-rate multiplication, because the positions have been reversed, it's 10540 with 1.9170. But I would never encourage anyone to do this. Do you know what I'd tell you to do under exam conditions? Just reverse the second quote. Just invert it. Always do it one way. So you just reverse and invert the USD pound, and then it's a very straightforward calculation. It's the same as before. Matching bid to offer, very easy to remember. Again, as I said, the reason this is reversed, we've reversed these two positions, so we need to now multiply, and because we've reversed the currency positions, we're not matching bid to offer, we're matching bid to bid, because they've been reversed. All right. What if you encounter a scenario like this? Well, then it becomes cross-rate division again, because they have a common position. They're both reversed. So you divide. Right? And we're matching 0.7862 to 1.9175. Okay, so again, we're matching bid to offer. Why? Because we have a common currency in the same position. Again, in my view, this is just my view, the easiest thing to do when you're new to currency is to just ensure that the US dollar is your base currency every time. Then you cannot make a mistake. How can you make a mistake if you just make the US dollar your base currency every time? Even if you knew nothing about what you were calculating, which I don't want, of course, but even if you did, even if you were drawing blank in an exam, if you have your US currency as your base currency and you do a bid match to offer, your answer is correct every single time. Good exam technique is as important as understanding everything perfectly. All right? There are two goals in any exam. And if you're drawing blank, in that unfortunate scenario, you still want to maximize your outcome. And so with all Forex calculations, even the most complex ones, once you go to a standardized structure, okay, particularly a common base structure with these calculations, becomes really, really easy. When you're doing multi-point arbitrage, it's really, you could do a 7-point arbitrage calculation, right, and get the answer correct with a really complex calculation by simply following basic matching rules. Okay? So you have advanced level subjects where they'll teach you this advanced level concept, but the reality is, if you follow basic matching rules, you bring it into its simplified mode, simplified structure, very hard to make a mistake. All right, so this isn't very hard though, because you're essentially returning to your original structure in part, but it's reversed. The positions of the currencies are reversed, and you just need to remember that. So don't you think it's so much easier when you do it that way? So if you were to encounter something like that, which is unlikely in this paper, but it's certainly likely in your next two finance subjects, okay, particularly in 760, that's how you go about doing it. All right. What I'm going to preface this with is this following material is very, very important, and it's a strong focus of a number of courses at the university. All right, and this is really the only place that you get a good grounding in it. All right, in later subjects, some of this is assumed away. Technically, you're supposed to be learning this in finance and in financial markets to prepare you for 759 and 760. Okay, so if you learn it well now, it makes your life much, much easier later on. I can tell students that have not come through my second semester intake when they get to 760, okay, based on their understanding of this one topic. Okay, and it's examined exhaustively then. Have I emphasized this enough? I don't know. Maybe. Important. So, not something that we're going to examine beyond a theoretical understanding at this level. You might be required to present a theoretical response at most, if examined. But in later subjects, you will be required to do these calculations. So, forward points and forward exchange rates. It's important that you guys have an understanding of how forward points are constructed and why they're constructed. All right? Again, you'll find that there are some really great textbooks on this. Read Ben Bernanke's book, brilliant book. Joshua Gantz's book, brilliant book. All right? Many of the books that are used in universities here do simplify this a little bit too much. You will often find that people present a forward rate calculation in a manner that suggests that you're figuring out what's happening in the future. You need to remember, before we do a single calculation, our goal in calculating forward points for one reason and one reason only. Why do we calculate forward points? You know the answer to this. Help me out, no? Forward points? No? All right.
Let's just set it there. There was the differential
Purely to determine what the differential impact will be on the currencies so we can quote. Only for that reason. We're not predicting the future, even if the textbook says that you can. All right, this isn't a prediction of the... In fact, if you were using this method to predict the future, all right, that's terrible. All right, no one should employ you. You're not working hard enough. But when you quote, for argument's sake, a particular contract, let's say for argument's sake you're trying to facilitate an exchange, this is the correct way to do that. Why? Because both positions are fixed initially. All right, so if I'm facilitating an AUD-USD exchange with a client, both parties are likely to have fixed positions initially, and this differential will govern the outcome. What happens in the real world in the future is entirely unknown. But it doesn't matter to these two parties, because they are facilitating an arrangement at a fixed regime, under, I should say, a fixed regime structure right now. Why? Because that's the certainty they want to bring to their transaction. They want to bring certainty to their transaction. We're going to facilitate the exchange through the bank. In the real world, one of them will look at the transaction and say, hey, I wish that I didn't do this. Clearly, because in the real world, the rates will be different in the future. We don't know what they will be, but we do know that if both parties initiate an arrangement now at this rate of exchange, based on these interest rates, neither party will be upset at the commencement of that contract. All right? In some respects, you might say it's a little bit like I'm not going to use the word hedging because it's not really hedging, it's fixing or locking down an arrangement to an extent. Some might argue that there's an element of hedging to entering into an FRA, okay? And I would say that yes, depending on your interpretation of the word hedge structure, you could lay claim to that. I think it's a little bit simpler than that. I think it's a simple acknowledgement of interest rate differentials and the fact that we want to transact today and not in the future. Some might argue it's a simple hedge. In fact, most would argue it's a simple hedge. So, a forward rate can vary from the spot due to interest rate parity, undeniably, all right? The actual forward exchange rate can vary due to the spot because of interest rate parity. This is true. But it isn't just interest rate parity that governs the difference. But when you're setting up contracts for your clients, that's how you set up a contract. So, forward exchange rates are quoted as forward points either above or below spot. Okay, forward points either above or below spot. What do we mean when we say that? Well, you have a current spot rate. That's the T+2 rate, remember? That's our current rate. If we want to offer someone a rate for the future, we're not going to offer them that rate. Why will we not offer them that rate? Okay. I'm going to put it to you like this, setting aside all knowledge of finance. All right. You have 100 Australian dollars. The interest rate is 10%. I'm going to use extreme rates just to make the maths a little bit easy, okay? The interest rate is 10%. Someone else has 100 US dollars and the interest rate is 20%. You want to facilitate an exchange in 1 year's time. Okay? So you have 100 AUD, they have 100 US dollars, the US exchange rate is 20%, yep, very extreme, Donald Trump has done a terrible job, interest rate is 20%, our interest rate is 10%. Okay, my $100, or your $100 I should say, in 1 year's time will be $110. The other individual's $100 in 1 year's time will be $120. Would it be appropriate for us to exchange in 1 year's time, if we initiate a contract today, 100 Australian dollars for 100 US dollars? Would it be appropriate? Well, we all know when we commence this contract that the equivalent value of both currencies when incorporating interest in 1 year's time will be 110 relative to 120. That should be the rate of exchange. That's all an FRA is doing. Figuring out today, while accounting for interest, what that rate of exchange should be today, given that rate of interest. Okay, so it's not appropriate to facilitate the same exchange today as it would be in a year's time, per se, because we'd have the impact of interest. So we need to, when offering a forward rate quote, account for the impact of interest. 110 equals 120. Trying to think of it in those terms. I think it makes it a little bit clearer. Now, people often try to explain this in a purely mathematical way, and I'll do that too, but I think it really helps to have that simple analogy in mind. All right? We're both going to enter into a contract to facilitate an exchange in 1 year's time. We're both going to set aside $100. My $100 will become 110. Your $100 will become 120. Why should I give you 100 of mine for 100 of yours when yours is appreciated more relative to mine? If interest rate parity theory holds, your currency should be worth less. We should facilitate an exchange for less in 1 year's time if we enter into the contract today for that exchange. All right, so that is the lovely formula. But we'll start with this. Consider the following example, 1 AUD USD exchange rate. So we have 1 AUD equaling 0.7830 to 40, and 6-month forward points, 0032, 0027. Okay? So you can see that in this example, we have a slight decline in forward points. Okay? What does this actually mean? It means that in the future, any number of things could happen. We don't know what's going to happen in the future, but if someone wants to exchange currency with us in the future, this is the rate that we'll offer them today, because this is acknowledging or accounting for the interest rate differential between both countries. So why do you think the bank doesn't give you the spot rate? Have you ever noticed that when you're trying to get a forward rate with the bank, you mightn't have done this, I'll concede, but if you ever get a schedule of forward rates, it's never the same as the current spot. Unless, of course, the interest rates between both countries are the same. You'll find that sometimes they're very, very close. And at present, if you look at the data, you'd be like, gosh, there's not really much difference. It's because the interest rates in the US and Australia are so close. All right, so interest is having little to no impact on the exchange. I shouldn't say no impact, it is still having some. There is still a differential, but the differential isn't very great because the rates are at historical lows within both markets. Okay, so this is the formula that you will use to do this calculation. As I've mentioned, in this course we don't examine the underlying mathematics to this because there's a lot of complexity to it, and it does warrant a full semester-long program. So when you do 760, we get to invest a bit more time in these calculations. All right? But we'll go through a vanilla scenario, a simple vanilla arrangement, step by step, and we'll do the calculations. So you can see the forward points are a function of the current spot rate and the differential between the terms currency and the base currency. This is why those textbooks that reverse that convention, it's so frustrating. All right? Because they're frequently presenting incorrect answers. All right. So we have a company approaching an FX dealer for a forward quote, US dollar to franc. The spot rate is 1.1560. We need to calculate the forward points, assume 3-month euro dollar rate is 3%, and the 3-month euro Swiss franc rate is 4%. Okay? So we're going to compare the euro dollar rate and the Swiss franc rate. We should know just by looking at them what's going to happen. In forward point terms, the euro Swiss franc is going to decline relative to the euro dollar. Okay. Probably haven't seen the word euro prefixing a currency before. So a euro currency transaction is simply a transaction involving that currency being borrowed outside its country of origin. So it's very popular to borrow US dollars in Japan and US dollars in Europe. There are huge US currency holdings in those regions. All right, so a euro dollar transaction just involves borrowing dollars outside of the US. Okay? It's funny when you end up with a euro-euro transaction. Not a very common one, but technically you could have a euro-euro transaction. A euro-euro transaction involves borrowing a euro from outside one of the EMU countries. Okay? So in this context, the word euro has nothing to do with the EMU. Here, it just refers to outside. In fact, these markets existed well before the euro as a currency. It's kind of frustrating in some respects that the same word is being used because it creates confusion. Okay? So here, just by looking at this calculation, we should say, well, hey, we know the difference is going to be approximately 1/4%. Okay? 90 on 360. Okay? So 1/4% is effectively the differential. Okay? Cool. So you can see here, 0.04 multiplied by the fraction for holding, 0.03 multiplied by the fraction for holding. We add it to 1. Why? Because we're accounting for the initial amount and the change. We multiply it through and we have our points. So it goes from 0.1560 to 1589. So lo and behold, as we expected, the franc has declined in forward point terms relative to the US. So that's the great thing about these questions. You know what's happened straight away. If the interest rate is greater with one currency, that currency must decline in forward point terms. If interest rate parity holds, it must decline in forward point terms. Think about our example, equating 110 Aussies to 120 US dollars. The only way that can happen is if one currency declines in forward point terms relative to the other. Okay, so we do need to make modifications to account for the fact that lending and borrowing rates differ. We then need to make modifications to account for the fact that we match bid rates to offer rates. Excuse me. Okay, so when you borrow in the euro market, you borrow at a particular rate. That rate is going to be higher than the investment rate. That means that you need to be aware of the differential. Equally, when you're identifying which rate to include, okay, you must always be matching bid rates with offer rates. Okay, so either your terms or base currency must be bid or offer. One must be bid, one must be offer. Okay, because you can't in the real world match a bid to a bid or an offer to an offer. It doesn't make sense. You have a particular role in the market, so you must match one with the other. Okay. Other thing to be mindful of, you'll note that there is a 360-day convention used when it comes to these transactions. Okay? Any transaction involving the euro market, okay, must use a 360-day calendar. Any transaction involving a non-euro market currency or a non-euro market transaction uses a 365-day calendar. Okay? This is just something that happened out of America. It makes the maths much easier because you don't have to account for those day variations between months. Every month you assume has the same number of days. You can assume 30 days per month. That's the only reason they created that convention. So any US currency transaction, any transaction involving the borrowing of a currency outside of its country of origin, euro market transaction. Everything else is 365-day calendar. All right. So finally, these forward point calculations are the next two sets. All right. So you can see we have bid and offer here. In the first example, we have forward bid points and then forward offer points. Okay? Okay. So here's an example that represents this. We have a 3-month euro-dollar bid and offer. We have a 3-month euro-franc bid and offer. So 3 must be matched to 4, 3.3 must be matched to 7. Okay? So you can see here, 3.3 matched to 3.7, 3 and 4, okay? 3.7 and 3.3, these are our bid points. So 3.7 is our bid, 3.3 is our offer. We can calculate bid forward points. This is the bid rate forward point, okay, for a bid position. These are the offer forward points. So we have our offer rate as the numerator. We have our bid rate as the denominator. And we can then calculate our offer forward points. All right. So a couple of things to be mindful of. You don't have to do those calculations at this level. Okay? Not at this stage. But they will be important in the future. You will need to do them in 759 and 760. I don't know why I let you guys know those sorts of things. I should let some other unit chair have the joy of telling you that at the time, having to share that with you. Anyway, at this stage, you get just the enjoyment of understanding the generalities. We don't examine all of the math at this stage. Okay, I might just skirt over that and call it today. I don't feel like we need to talk about EMU transactions too much at this stage. There is something noteworthy, I guess, that we should probably discuss around this material. One of your simulation questions deals with arbitrage. Okay, so one of the two questions outside of topics 1 to 4 is a question that deals with arbitrage. Okay, transaction sequencing. Yes, yeah. Yeah, so some of the questions are not standard quiz type questions. They might involve, for example, sequencing or matching, or for argument's sake, entering into a particular transactional position, not entering into a particular position, but for all intents and purposes, it is very quiz-like. Yeah, effectively. Okay, so one of those questions. We'll provide you with... That quiz will open the Thursday. Yes, there's a little booklet that, actually I'll go through it today too. There's a little booklet that comes with it, explains to you how to initiate it, how to open it, how much time you'll have, so on and so forth. All right? But you have up until the final census date on the subject. Okay? Final census date on the subject in terms of completion. So effectively the last Friday of week 11. The Saturday of week 11. Yes. Saturday of week 11. I'll give you the exact date. It'll be in the email. I just can't remember it off the top of my head. So you have approximately 3 weeks to do it. Okay? All right. Well, we'll have a quick break, and then we'll talk about your quiz simulation, and we'll then do some exam papers and exam questions. All right. So we'll go through the preceding topics, and we'll do some associated questions. All right. Be really, really, really good if everyone could kind of have a calculator in front of them and a pen and actually maybe do the calculation as I do it. We'll try to do at least a full paper today. Probably get through a full paper, and we'll get through some other revision as well. All right, well, enjoy your break. I know that a few of you guys still have an assignment due this evening for another subject, so you've done very, very well to come here today.
I just made you the Excel sheet that I worked for my IPO.
Oh, good.
Please receive that. Because I could attach that to my Word document when I was just uploading.
Yeah, so you can do 2 stages of attachments. You can attach the main document, and then you can attach other things too. But it's all good.
Yeah, I just attached it, but I'm not sure that it will work.
It's fine. All good.
Thank you.
No problem at all.
Michael, just
There you go.
wondering about the handling for the assignment too.
Yeah.
Yeah, I had it in yesterday, but it's all like in the deacon that was only assignment 1, it says.
There is only one assignment. So there's assessment 1, which is assignment 1,
Yeah.
and assessment 2 is it?
Yeah, because the 4,000.
Yeah.
Yeah. So
Yep.
it's right that I added it.
Yeah.
Okay, it's right.
That's the correct one.
Yeah, because it was like, it says 3rd of September, but I thought like 2nd September was the deadline.
It is.
I kind of got a little bit confused.
It's so what it does is it's set. The due date is the 2nd of September,
Yeah.
but it's set to accept assignments for a certain amount of time.
Okay.
That's when if anyone hasn't submitted by that date,
Yeah.
it sends them a message,
Okay.
and then they have a further 4 days to submit, and then it won't accept.
That's how it
It's the new rule. Yeah.
I didn't know
So,
that. But
so
I did hand it in before.
that's fine. So
just like a little bit
even if you
confused.
handed it in on the 3rd, it's not too big a deal.
Okay.
It's more that by doing it that way, it's the flag system. So it doesn't. It means that if some students are frantically sending something on the following day, it doesn't send them that email unless they miss that date. If they miss that date, then
That's how it works.
then they get. It's called an intelligent agent.
Okay. I just got a little bit confused.
Yeah. So you won't get any messages.
No, okay.
You'll get a congratulations, you finished your assignment at some point, but you won't get any of the auto. We use the intelligent agents because some candidates they don't submit on time, and so this just kind of gives them a little bit of a push.
Oh, okay, a little bit.
Yours is good.
Yeah, okay.
No problem.
Thank you.
All good. Yeah, I'm sure it's fine. Did you submit it?
Yeah, I submitted. Like, the cost structure and revenue structure, I couldn't like understand like what I should write. Okay.
Oh, okay. So the cost structure is essentially their cost model,
Yeah.
and the revenue structure is their revenue model, so how they generate revenue. Yeah.
So I just like abstract like this. Like the purpose of the study is to describe the major impact of financial markets and ways that face the challenges and unfavorable conditions for both an international practice. How its distinctive approach towards e-commerce and online shopping made it a leading company worldwide. Since my study is more literature oriented, I have chosen Ashmolean methodology for describing my study more efficiently.
Good.
Yeah, it's good. Yeah, have you uploaded it?
Yeah, I uploaded it, but like I want to make some changes and upload it again.
Sure. Yeah.
With the methodology and
All right. Yeah. Look, the other thing I'd say is there's clearly a few sections here where you've taken from other places because the text color is different.
Okay.
So try to fix that before you hand it in.
okay,
See how it's grey and how it's a different color?
okay.
Yeah, so you have to just maybe typeset it quickly. No, it's all good. I can appreciate it. It's challenging when you're working and studying and doing all the rest of it.
Definitely prepare off more changes.
No, it's all good. No, just drop us an email a little bit earlier next time. It'll make you feel better.
Oh, man.
You know what I mean? Because I've had a few in that situation, but at least you provide some actual detail. I had a lot of people say,
Need time.
it's a lot of like,
counsel.
first of all, I hate when people, I had a whole heap of people that literally just said, please, Professor, I'm freaking out, I need more time. And you need to give someone a reason to give you more time. You can't really do that. You know, and in a lot of cases I kind of have, I've said, look, you know, if you could supply me with, you know, some of the challenges you've had, you know, you can have some more time. But look, you do want to submit something that's of a good quality. No, it's an investment of time and energy, and you know, look, I dare say with academics here too, like, you know, if you some of the you know, kind of more old world academics and stuff, you know, if you want them to give you endorsements and references and things, it just makes sense to put something in good and build rapport, and they'll always look out for you. You know what I mean? So I'm guessing that the others will probably give you an extension too if you've given them, you know, some reasoning as well. But look, some people are a bit more old school about this, and
And I don't want it, so it's more of your
because look, a lot of them have kind of come from a model of education where they got to study exclusively when they were at university, and so they don't really understand why people, you know, can't. So often you'll get a responsible, you know, this is what I had to do. Well, it was a very different model. So as long as people, you know, so the only thing next time is just more for your own headache, you know, you just drop an email through a little bit earlier. You'll find that there are some good ones, you know, like particularly a lot of the accounting academics, and you'll find that a lot of the financial planning academics, and also to an extent some of the finance guys, you know, are pretty good. There are a handful of guys that are, as I said, a bit more old school. You'll know based on your interactions with them. You know what I mean? Well, you know, so that's kind of how you gauge it, but more for your own psyche, because there's nothing worse than feeling like you're not going to hit a deadline, and then when you get to the deadline, it's just, no, exactly, it just creates kind of, and it affects other things, you know, it affects your interactions in other ways, and so I just say to them, well, exactly, that's what I mean. No, but if you'd have dropped me the message on a Friday night, I would have gotten back to you. On Sundays, I only do email in the evening. And this Sunday, because we had to go visit my in-laws, so ordinarily I get back to people kind of Sunday at 7. But you had the worst of it because you sent an email Sunday after. Saturday, yeah.
Don't stress, because I knew you liked it before.
Yeah. So I dare say if you ever send something, if you send something even on a Friday, you'll find most academics get to it. Some academics have a rule of not checking on the weekend, but you'll find that. I don't know. I don't think people like me will mind because we kind of interact with technology kind of freely. But there are some people that interact with technology based on, yeah. And so for them, they mightn't always get back to you super quick. But no, it's more for your sake because knowing your situation, I felt. That's what I'm saying. You know, like you don't want that. It's a kind of a nice, you know, and you need to enjoy your weekend. Yeah, and with the other one too, you'll probably find Longchan's one of the pretty laid back. She's pretty good. She'll probably get back to you too. Longchan, she'll probably get back to you too. She's kind of a bit more of a modern and sort of academic type. So I'm sure she'll be kind of open-minded. You're doing 2, right? How many subjects are you doing? You're doing full load, okay. Well, I don't know about the others, but, you know, that'll...
No, I actually scrambled enough to get
The others done?
the finance one done.
Okay.
So, like, one has to go. And
Yep.
I kind of made the assumption that you'd probably be a bit more late. So
Yeah,
I
look,
kinda-
it's
like I
honest.
said, no bias towards it.
No.
So
Look,
it's more just-
I can appreciate it. At the end of the day, someone has to kind of be real about the modern student experience for people too. And there's a reason that they make me share the first subject and the last subject.
Okay.
Yeah, there's like
Transition.
kind of thing. There are some people, you know, that you probably wouldn't want, you know, involved first up. You know, and
First time round, like, I was an 18-year-old kid,
it's very different.
hard Russian man, teaching, you know.
I remember someone pressed a button on their phone in one of my first econometrics lectures, and the chair actually went over and yelled at him and threatened him and told him that if he didn't leave then and there, that security would be called. And then when he didn't understand, because he was a foreign grad candidate, he went to the phone. And then at that point we were like, oh look, we'll help you out later, don't worry.
Where was this?
This was it was actually at a subject here I took in when I was when I did a grad program here. I've done a million different things. I used to teach econometrics and moral philosophy as well at other places. So I've spent a lot of time doing a lot of development economics work. So yeah, I have lots of degrees that are entirely irrelevant to here. I'm a bit of a career being at school. Even when I worked for PwC in Quartermentha, I taught a subject in Melbourne. So I've never not been involved with something. So yeah, I've got lots of interesting stories to tell. Sorry? Well, yeah, look, and for mine, I mean, I've only, as I said, you know, I came from a traditionalist background. You know, AI wasn't a thing back in the day that, you know, was actively pursued. We learnt a bit about it, but, you know, you couldn't really actively pursue it because it wasn't a defined area. And so for a number of us that are in this field, we all come from econometrics or economics or something else. But no, look, no problem at all. But I just more for your own psyche next time, you know. All good.
Find the topics which will be due on this.
Where to find them?
Yeah.
You haven't picked a topic yet.
I've picked the topic.
Okay, great.
I was doing earlier, but I just want to have all.
So what topic are you doing?
Right now I'm with Brexit.
Okay.
Yes, Brexit.
Okay, great. So it's a bit late to...
Yeah.
You want to change your topic now?
No, I just want to go through all the topics once
Why though?
because I don't think to
Do
properly. It's been a bit worrisome.
Okay. Do you feel like it's a good idea to change now though?
I'll try my level best.
Do you need some extra time? Yeah? Yeah, look, maybe email through and I can send you... The topic list is still where it was. The awkward thing this semester is that I put it in one spot and students have been replying to it. So if you go through the email, if you just search my name, so if you go onto the cloud, go into that discussion, just search my name, and it'll be one of my posts. You'll see topic list. That's the easiest way. Or if you send me an email, I'll send you another copy. Okay, either way is fine. But, yeah, I don't know if it's the best idea to be changing the topic now. Why didn't you reach out earlier? You could have just called
but
or...
the thing was, I wasn't that well. My health was
No,
not
but that's
that
a
good
very
because of
important
flu.
reason to
Yeah.
contact me, and you know we're all here to help. You know, because now it's past the due date, it makes it a bit harder. So look, try to submit something. There are some topics that are probably more qualitative than others. I think the topic you've chosen is a pretty easy one in some ways, but it depends on you. You know, there's a lot of research on your topic. Maybe you could just do a literature review. Just say that you could do a literature review of other studies for now. That could be something to do, you know? That's an achievable thing, you know, you download maybe 20 or 30 studies and you'll get you a good mark, an adequate mark, you know what I mean? That's still going to be sufficient to get you through. Doing something entirely new could be... Have you done any work on your current one?
Yeah, I've done.
Then why waste that?
I don't think whatever I've done till now is not that satisfying for me, especially.
You don't have much time left, though.
Yeah.
You've only got a couple more weeks in the course.
Yeah.
Yeah. Look, I'm more than happy to give you more time, but I can't give you any more than the end of the course.
Yeah.
You know that's...
Yeah.
And the rules state that if you have an extension beyond 1 week, then there are rules around like a deduction after that.
Yeah.
Yeah, so we have to, maybe we can have a quick conversation and try to find a strategy for you that works. I don't know if changing a topic right now is the best idea. No, if you could just do something sufficient with what you've already put together, that could be a good outcome. Because you already looked at all the topics previously when you chose your topic.
Yeah. Sorry.
When you chose your topic, you would have looked at everything then.
Yeah, but I think specifically downloaded each and everything. I just pick this up.
You can pick any topic.
Yeah.
Yeah, you can pick any. All right. Whatever. Look, yeah, just email me, okay?
Yeah.
Yeah. No problem at all.
See you.
See you. Okay. All right. Okay, so ordinarily I would do a brief review lecture today too. So we normally do one week 8, we then do another one briefly in week 10, and we normally like to do some sort of workshop session in week 11. Because there are quite a few people today that appear like they're still working on their paper, I think that if you guys don't mind, just to do right by them, we might delay it for 1 more week. And we will still do some revision today. We'll do some exam questions today, but I won't do a full course revision today. All right. I know that you might feel like it deleteriously impacts you, and I do hope that you understand sometimes we have to sort of make these accommodating actions just to ensure that we have good outcomes for everyone. Look, in truth, it shouldn't really deleteriously impact you because I haven't really told you about my intentions to do any of this anyway. So we will do a review session week 9. So we'll do our standard lecture, we'll then do our review session, we'll then do some exam-style questions relating to each of the weeks in a structured way. And we'll do something similar again in week 10. And then if you would like to, in week 11, we'll do a workshop session with some of my grad students as well, where we can go through a full paper. You can do it independently, and there'll be a whole heap of PhDs and grads that can give you a hand one-on-one, in addition to myself. That's an optional session that I'm happy to do. I personally do think it's beneficial to do every semester, but I just want to make sure that there's sufficient interest in doing that. Okay? And I did also promise to sort of include you guys in that catch-up session that we're going to do with industry, but that's likely to be in about 5 weeks' time. So I'll send you guys an email about that after you've completed the subject. But how does everyone feel about that? It's a democracy and a meritocracy. I like to treat people like grown-ups, so I like to take feedback on what we're going to do. Do you feel like that's going to be a viable approach? How do people like to do revision? Do you like to do revision independently, or do you get some benefit from doing some revision collectively? Because technically, I'm not required to offer a session, nor are you required to attend. So the session won't be here. The session will be in the corporate centre, out of the corporate meeting room. Okay? How does everyone feel about that model? Do you feel like it will be beneficial, or would you prefer to study independently during that week? So essentially, it will be a workshop setting. There'll be 2 papers, all right, and we'll go through it once as a group, and then people can independently work on the paper, and then we'll correct it together at the end, and then we'll go through that process 1 more time. I feel like preparing for exams and developing good exam technique is really, really important. It bodes well in so many situations in life, okay? Developing methods of approximation, understanding how to use deductive reasoning well, all of those skills are really useful and transferable. But I'm not going to do a session if it's not preferred. I know some students like to just get into their room and, just sort of study independently. So any sort of feedback would be really, really helpful, because I'll need to book that in now, because obviously that time is a very, very busy time in the semester when it comes to the corporate centre. We run a lot of conferences, so I need to make sure we have availability. So just with a quick show of hands perhaps then, if no one wants to audibly provide any feedback, how many of you would benefit from some sort of workshop session in week 11? Okay, I appreciate the honesty of people that are not raising their hand, thank you. All right, so it's about half. So look, I think we'll do that. What I'm going to make clearer though is that I can't record that session. Okay, there is no recording facility for that. So what I will endeavour to do is put together some sort of similar summary session, or I'll endeavour to get one of my grad students to bring a camera along, or we'll figure out some way to use the onboard cameras in the room to do that, because it's not a lecture space, it's a workshop space. All right, so we'll ensure that those that don't attend do get a similar sort of benefit. Okay, so just to confirm, front of the campus. I'll give you guys directions too. Front of the campus, it'll be on level 1 in the interactive workspace 1. All right. So just to confirm, today, some Q&A. We're going to go through some exam-style questions. You're going to develop a feel for the assessment. We'll talk about some of the preceding weeks and the material that we've covered. Next week, we'll go through the material. We'll also go through a full revision lecture, okay, which will go through each topic again. We'll do our final revision in the following week with an additional exam paper. And then during the workshop, you'll have the chance to spend some time in preparation under a more exam-style, general workshop-style setting. And we'll endeavour to provide a similar sort of experience or set of outcomes for those that are online as well. Okay? All right, so what we're going to do just to start with is just sort of talk about this course in a broad sense, some of the things that we've covered off on, and some of the things that you're likely to see as the core focuses for your final paper. What I want you guys to appreciate is that this is a breadth unit, all right? They needed to give someone a breadth unit to take that was kind of comfortable preparing you guys for academic writing. That was one of the big goals of this course, was to prepare you guys for other subjects. And I'll concede that this was not something that anyone really wanted to do. I enjoy the process because I think it's nice seeing people develop these skill sets and propensities. And so a big part of this course was about developing that foundation, breadth understanding. You cannot be examined on all of the competencies that we focused on in this course. There are simply too many, okay? That would never happen. Okay, so in this course, what we generally focus on are the foundational concepts, all right? In finance, you focus on some broader generalities around non-market operations, around corporate finance, around structured finance. In this course, the point of difference is that we have a strong markets and instruments orientation. It's very focused on introducing you to pricing and the foundational concepts relating to pricing instruments in particular, okay? So we focus on the theory and the calculations relating to those. And those problems have been interdispersed in each set of lectures. If you can do the questions in the lecture notes, this final paper will be a remarkably straightforward one for you. Okay. So you're not going to see anything surprising or anything remarkable, anything that's unique or unseen before. Okay? So how do we start off the course? Well, we started out in this program introducing markets as a whole, in the broadest sense. And we discussed the interplay between institutions, instruments, and markets. So in this course, we focus on instruments and markets in particular. Our ancillary focus is on institutions, okay? So we spend a lot of time learning about those core concepts in week 1. In week 2, we shifted our attention to the institutions categories. There were 2 sets of lecture slides then that you needed to review, one focusing on banks and the other focusing on NBFIs. Okay, so banks and NBFIs. But the key takeaway from that discussion undeniably relates to regulatory institutions. Okay? So you need to develop a familiarity of the core regulatory institutions in relation to the system. We then shifted our attention for a couple of weeks to share market activity. And when we discussed share markets, there were two distinct orientations. We took the orientation of an investor, and we looked at the pricing of instruments, pricing of shares, and pricing of rights. Okay? And we then shifted tack, and we looked also at the perspective of someone engaging in fundraising. So why you engage in a fundraising effort, and why, for argument's sake, an on-market offer might be beneficial relative to, for argument's sake, a private placement. We looked at the different and varied approaches that you can take to capital raising. We then shifted tact again to focus on debt instruments, all right? And we looked at debt instruments in some detail. In fact, we've devoted 2 full weeks to debt instruments and 3 sets of lecture slides, all right? So undeniably, the pricing of bills, the pricing of bonds, and the pricing of mortgage-related transactions is of immense importance, okay? So those 3 sets of calculations. And you've got a few examples in the academic program, but in particular, you know, in light of the time that you have, I really want you to devote your attention to those lecture notes as your starting point. If you do need extra material, there are a number of textbooks that you can review that I've provided that cover off on those topics well, albeit I do concede that they are a little bit more involved, okay? Then we devoted our time and energy to an extent to talk about the government securities category of instruments. And so our focus was on treasury bonds and treasury bills, ratings agencies to an extent, but in particular, monetary policy and open market operations. So when it came to a theory focus in the course, that was a particularly important theory focus. So monetary policy and open market operations. So we devoted quite a bit of last week to that discussion area. So you need to be able to articulate in this course a monetary policy program and how open market operations are utilised to elicit a change within the market. All right. In this current week and in the final weeks, our attention will be focused on international market transactions, financial market innovation, and derivative securities. What I'm going to make very, very clear, and I think my exam structure makes clear, is that derivative securities are not exhaustively assessed in any way in this course, because we cover derivatives in full in our new derivatives unit. We have a devoted unit of study that focuses on derivatives. So that's been taken out of this unit as a focus and is now a part of that dedicated unit. Okay, I always thought it was very, very unfair for everyone to learn about the derivatives category in 1 week, because it is a very technical area. Okay? So you are going to cover off on all of that material. In fact, I have over 189 slides on derivatives. And that's just for your record, because it's a good summary of all of those instruments, but it is going to be provided to you for your record. So we're going to have a 30-page summary of core concepts, and we're then just going to focus on review. So please be mindful that that final week is not one that is examined in the same way as the preceding weeks. Okay, there isn't the same level of expectation when it comes to that final set of slides, because I think we're all in agreement that derivatives is a 12-week course, not a 1-week course. All right? So with that said, they are our focuses. The exam that you see, and I'm going to be very honest with you about this, I don't know if anyone else has told you this, but there are 3 exams that Deakin releases. Deakin has one of the most exhaustive and unique examination models of any university in the world. And it's one of the things that there are some things that frustrate me about this place, but when it comes to assessment, we do that very, very well. There are 3 versions. So I can't actually tell you the version that you'll see. Those versions are required to be 30% differentiated. Okay? So the version that you see will be a function of the examination centre that you sit from and the time zone that you're in. You will get one of those 3 versions. Okay? So normally there are 2 versions that are used locally. One is used for the Melbourne-based cohort. We then have a version that will be used most likely for the online cohort, okay, with 30% variation between the 2. But even in the Melbourne-based cohort, you could get one of those 2, depending on where you sit and when you sit. Okay? So the online cohort and Melbourne-based cohort will potentially see 1 version. Then if you are a clash or non-standard candidate, there will be a 3rd version. In fact, last trimester, because of the unique nature of last trimester, there were 4 versions of the paper. Okay? So for that reason, I like to, when I talk about the focus of the paper, talk about that 70% discussion, and I then have a discussion that we offer in relation to the variation. I cannot tell you what is in the varied versions of those papers. What you see, the version that you see, is entirely at the discretion of the examiners. I only find out 1 week later. Okay, so I'm going to make that very, very clear. I do not know prior to the assessment. But one thing that is clear, we examine all the same competencies, but we examine them in slightly different ways for that 30% variation. So when it comes to the focus of the theory questions, same core concepts, but subtle variation in relation to the way that they're examined. Okay? There will be, in each paper, generally, 2 distinct part questions. So 1 full question that's varied, or 2 parts of the 5 questions that are varied. Okay? They will be distinct. And so, if you, for example, are to compare after an exam your responses with anyone else in the cohort, you could technically have different answers to a similar set of questions because the numbers are different and some of the focuses are different. All right? So please be mindful of that. The following paper is a good representative paper. Okay? You'll get 4 sample papers in this course. 2 will do prior to that final week and 2 will do in that final week. Okay? They're a good source of preparation, and I would encourage you to try to do them without the benefit of solutions. In fact, I'll probably not give you the solutions straight away because most of you will not be able to fight that urge. All right? So you'll probably get the solutions a week later. All right? So endeavour to attempt them on your own, and that'll be good preparation for when we come together in that final week and do a workshop. So I'm going to show you how quickly we can respond to a paper, how expediently we can respond to a paper. In truth, a 2-hour paper like this more often than not can be completed within well under 1 hour. That gives you ample time to review your answer and really in particular improve on the theory questions. I do find historically students find theory far more difficult than calculations. All right, students all come to terms with calculations at the end. They freak out about calculations for the first 8 to 9 weeks and then they come to terms with them remarkably quickly at the end. When you know that you need to know a compelling area of study, you learn it, and mathematics is something that can be learned in a very structured way. Theory, however, everyone learns differently. Okay, and you need to figure out how it works for you, whether that involves summary notes, in fact going into the textbook, maybe reading a little bit more, or for argument's sake, just working out of the lecture notes, whatever your preference is. I would encourage you to do something substantive though. You know, pick one of those approaches and actually go through a formal process of review. I know that legal studies are very, very different, but I do like the approach that law students generally take to a process of review. And that's ensuring that they go through every segment of a syllabus and actually review their understanding and go through a checkbox exercise. I do find that business candidates in social science disciplines outside of the law tend to take a slightly more haphazard approach to review. The best thing to do is start from slide 1, go through to the final slide in the program, and just ensure your understanding of each thing. It's not a hugely complex exercise. For all intents and purposes, you have about 50 slides to go through on a week-to-week basis. So let's have a look at the sample paper. This is a sample paper. As you can see, you're allowed to use calculators and a formula sheet is provided. I'm going to furnish this formula sheet to you now because your exam has been approved. Your exam was approved yesterday, which is why I can do this today. So you will receive this formula sheet in your final paper. Okay, this is the version of formula sheet that you will use. I do note that it is different to perhaps some of the versions of formulas that you would see in other classes. All right? There is some variation. Some people use different versions of the formula. You can use whatever you're comfortable with. I don't mind. I would encourage you, however, to write your answers out in full. Okay? Write your answers out in full by articulating the formula, including the inputs in the formula. All right, so your paper will be, for all intents and purposes, similar. I will concede, however, that with the new version of the paper, the model that we're going for is consistent across all exams, and it does involve some multi-part questions, not dissimilar to this, but more often than not, there is a set of calculations and an associated theory problem. That tends to be the more model approach now. A lot of these things you have, however, seen already. So let's go through and do some calculations now. Okay, so you can see question 1 relates to topics 5 and 6 and 7 to an extent. All right, it is a question relating to mortgage installments. We did something quite similar in the lectures. Okay, it is a little bit different. because of the payment frequency, but again, quite similar overall. So the question asks us to calculate the monthly instalment for a mortgage of $600,000 over 20 years at a rate of 7.8%, payable at the end of each month. The last instalment will pay off the mortgage. Okay? So what we would ordinarily do is we would go to the appropriate formula, we would identify the appropriate formula, and work from there. Okay? So what is the appropriate formula? It's the PVIFA formula, present value interest factor of an annuity formula, sometimes referred to as the standard annuity formula. Okay? What is that formula? It's bracket 1 minus 1 plus I to the minus n on I minus n. Okay, bracket 1 minus 1 plus I to the minus n all on I. Close bracket. Okay? So where is that formula on your formula sheet? Well, if you were reviewing this formula sheet, you would go to the section denoting simple annuities. And you can see this is where students encounter difficulty. Is it an accumulation or is it a present value? Okay, students frequently use the accumulation formula incorrectly. Okay, when you're taking out a loan, the value of that loan is in present dollar terms. You always use the present value formula with mortgage calculations of this type. So there is our formula. Okay? So on this occasion, we have a value of R. R is the installment amount. Okay? You can see we have the annuity formula next to it. On this occasion, we actually want the installment amount. So we need to solve for R. Okay? So you can see that's the accumulation value. And there we have the value that solves for R, or the version, I should say, that solves for R. Okay? So A is our loan installment amount, and we have our annuity formula. So let's do our calculation. It would normally be much faster than this. I'm articulating every step. You wouldn't need to do that to yourself in an exam, obviously. So let's return to that first step. What I'll do is I'll use the equation builder so you can see it very, very clearly. Obviously, under exam conditions, you would not need to articulate things quite as clearly as I do, but I do think it does help. It does always help. So we want the installment amount PMT, and that equals what? Let's use a fraction. Make it look nice. Okay, we need another fraction up here. There we go. So we have bracket 1 minus 1 plus I to the, well, what am I doing? I'm putting an exclamation mark in there for you for some odd reason. And there we have it. That's our first one. So I'll put some numbers to it, because you probably want to know the answer, I'm guessing. Yes? No? Yes? All right. I appreciate that. That's probably the first time you've interjected. I really appreciate that. Thank you. Happy to take contributions even at the 11th hour. I do appreciate it. So we have our loan amount of 600,000. You know what? I'll keep it in this formula format so you have it in that formula format. Okay. So let's do that. 600. Okay. Then we have 1 plus I. What's I? It's 7.8%, but it's 7.8 divided by 12, so we'll do that. Okay. What's our value of n? Sorry, it's a little bit tedious in equation builder. Got to click in the right spot. Sorry about that. 120 plus 120 is 240. And our value of I. There we go. Done. Okay, much, much quicker in reality. You're not going to write it out as 0.078 divided by 12. I appreciate, you'll calculate that. You don't have to go through all of those steps in that manner. I'm doing it for the benefit of clarity. Okay. All right, so let's concern ourselves now with how we calculate the interest per payment and interest in an overall sense. So our interest in an overall sense is going to have to be a function of the payment multiplied by n. Okay? Let's see. I'm trying to think of how to do that neatly. Now I'll just do everything very neatly today so we all have a record. Yeah, that's how we'll do it. Okay, so we'll go PMT times n, lowercase n, equals total payments. Then we have Yep, cool. All right. So as I said, each semester has slightly varied assessments and varied focuses. Obviously, it's the nature of any course. This is not something we've emphasized as much, this next question, in this trimester, but we have covered off on it. It's the nominal versus effective rate question. You would have covered off on this also in your earlier subject. Yep. No, that's simply the average interest per payment. The only way that you can calculate the relevant interest per installment is if you actually calculate the accumulated payment value and then determine interest based on the net amount. And at this level, that's not expected. Because it, of course, exactly, yep. Look, you can do it through approximation too. Like, it isn't that hard to do because you can simply look at the number of payments that have been made and calculate an approximation pretty quickly, but it's not really beneficial in assessing someone's logic at this level. So we don't expect you to do anything other than the average. All right, so next consideration. Next consideration. I'll make it a bit clearer. Actually, what I'd undo all of it. Anyway. There we go. There we go. Average interest per payment. This next question requires that you have a an understanding of the distinction between nominal and effective rates. So obviously on bank product disclosures, you'll have an effective rate quoted and a nominal rate quoted. You need to appreciate how the bank moves from a nominal to an effective rate. All right? The nominal rate is simply the per annum rate that doesn't account for compounding. The effective rate is the per annum rate that does account for compounding. So how do we go about doing this calculation? Well, you can think about it intuitively, to be honest with you. All you need to do is divide the rate by the number of intervals and take it to that relevant power. Okay, but you are supplied with a formula. Okay, there is a formula for every scenario. So how do we go about doing this calculation? Okay. All right. So you can see here, it's very, very similar to your standard calculation. All right, your standard calculation for compound interest is denoted here. And this is mathematically very, very similar, okay, to the standard. All we're doing here is we're calculating the rate rather than applying it to a dollar amount. All right? So with so many of our standard calculations in relation to PV and FV, we apply a particular PV and FV factor to a dollar value. On this occasion, the question requires that we calculate an effective rate. So all we're doing here is not accounting for a dollar value, we're accounting for the rate on its own. So the standard formula is the rate, J, divided by the number of compounding intervals per year, M, and then N is multiplied by N. So we then multiply, or my apologies, we take it to the power of, we do not multiply, we take it to the power of the appropriate compound interval. On this occasion, you'll note that the calculations are annual, all right? So if you're working in monthly terms, it's going to be 1 multiplied by 12. If you're working in quarterly terms, it's going to be 1 multiplied by 4. So for all intents and purposes, it's just the compounding frequency or compounding interval. Pretty straightforward. All right? So that is the equation that we're going to use. It'll make much more sense when we do some calculations. Yeah, so on CFA exams and CPA exams, you're allowed to do approximation calculations where you use multiplication. Here you can't, you have to use a power. Yep. I'm going to rewrite it fully. Yeah, so I'm going to rewrite the equation for you. Actually, I can make it a bit bigger though. No, I take your point. It's a bit too big now. There we go. All right. So, let's do the calculation. Bracket 1 plus 0.1160 divided by 1 taken to the power of 1 minus 1. Okay? So did we need to do this calculation? No, it's a waste of time. All right? We didn't need to do that calculation because the compounding frequency is annual. So the nominal annual rate is the effective rate. But with the next calculation, we actually do need to do one. 1 plus 0.1140 divided by 2 taken to the power of 2 minus 1. Please remember minus 1 is the final step. If you enter that into Excel, okay, Excel doesn't apply the same logic rules around mathematics, so you need extra brackets. So when you're checking this, please be mindful of that. All right. So who has their calculator out? Everybody. No. I think 2 of you have calculators out. All right, that's fine. All right, we're going to have to rely on my mental arithmetic then, I guess. That's okay. I had breakfast this morning. I think I should be reasonably accurate today. 1130 divided by 12 taken to the power of 12 minus 1. Things always seem much harder than they are. All we're doing is accounting for the compounding frequency. The greater the compounding frequency, the greater the impact. So we're trying to figure out whether a slightly higher rate with a lower compounding frequency is better than a slightly lower rate with a higher compounding frequency. That's what the question is trying to teach you, trying to get you to think about. So when you're doing a calculation like this, please bear in mind that, you know, with that first step, I don't even expect you to do a calculation. Okay? You don't even need to go through that rigmarole. I don't even need to spend 3 to 5 minutes on it. Just tell me the answer will be one and the same. That's fine. Equally, if the answer is very, very obvious, actually no, in this case you're required to calculate them all. Some versions you're not required to calculate them all. In this version you are. So yes, you have to go through calculating the second and third one because they require a calculation and you need to compare them. All right, any questions before we kick on? We're making good time. We've got almost half the paper done and it's only taken us 9 minutes so far. All right. Obviously there'll be theory in your exam too. Theory takes time. I don't pretend that it doesn't. Sorry? It's about 60-40. No, 60 calculation, 40 theory. The theory takes easily the most time, 100%. Okay? But it's not unrelated theory, not unrelated theory. Okay, so now it's a little bit more fun. This is the kind of question that you'll ordinarily get some theory with. So there's multiple iterations of this style of question. You might be, for example, required to calculate an implicit rate or an extrapolated rate. Implicit rate or an extrapolated rate. Okay? So it's easy to be confused about which direction you're going in. Am I using short intervals to calculate a long rate? Am I using 2 long intervals to calculate a short rate? Ask yourself that question. Once you've considered that question, then you can figure out what you need to do next. If I'm calculating an interval within a longer rate, I need a rate that's above and a rate that brings me to that point. All right, so I need a rate that subsumes the entire interval and a rate that brings me to that point. So the only formula that allows me to do that is this one. Where is it? Have I given it to you? Oh gosh, I hope I haven't given you too much direction about your paper. Well, I haven't given you that formula, and so clearly you don't need it. All right? So clearly I'm calculating an interval rate anyway. If you were in the other scenario, you would have to calculate a longer rate. When you're working with a series of short intervals, this is the approach that we take. A series of short intervals extrapolated into a longer interval. I should have just put them all on there. I don't know why I didn't. It's already a very long formula sheet, so I was trying to be a little bit fair. All right. So, remember our notation. Okay? We have an implicit rate. There is a number that precedes the I. There is a number that comes after the I. The number that comes before is what? That defines our starting point. N. The number that comes afterward defines our duration. K. Okay? Here, we need to solve for an n value using a series of shorter n values. Or to put it another way, here we need to find our rate in the long term using a series of shorter term rates. So, we need to calculate 0I3 and 0I4 given 0I1, E1I1, E2I1 and E3I1. Okay, so we have the current 1 year rate, the 1 year rate in 1 year's time, the 1 year rate in 2 years' time, the 1 year rate in 3 years' time. A lot of information. How do I know that I can calculate 0I4? I look at that and it doesn't jump out at me that I can. But clearly, if I have the 3-year rate, my apologies, the 1-year rate in 3 years' time, I'm subsuming that interval at that point. So how do I calculate 0I3? 0I3 has to be 1 plus my initial interval rate. Okay? Is there going to be any power here? Well, there is implicitly. There's a 1 there, but we don't need to record it. Okay? My apologies. Let me fix that one up. 1, 4. 1 plus 0.15. Okay. So what I'm going to do is, just for the benefit of those of you that will use Excel afterward, add some extra brackets. Okay? Okay, so what do I need to do next? I need to find 0I3. Okay, so these together equal 1. This is calculating it without using the formula. You have a formula, but this is the logic exercise that underlies that formula. Equals 1 plus 0I3 to the power of 3. Very good. Thank you. So what do I need to do? This is how the formula is generated. I take this to the power of 1 on 3. That's why it's 1 on 3. 1 on 3. And what do I do next? I deduct 1. And that's the formula, the one that you're given. And just for fun, I'm going to let you guys calculate that in your own time. All right? It's very important to apply the powers correctly. Make sure you deduct 1 at the end. So just go through that sequence of steps yourself. The great thing about this, if you have a scientific calculator with a memory function, it becomes a very easy question to do if you're doing 2 calculations in sequence. But for those of you that are not familiar with that feature, I'd still encourage you to do it longhand, okay? Okay, so it's often the case that you'll be examined on an associated set of theory problems. Okay, in the equivalent topic, we would ordinarily consider things like market segmentation, pure expectations theory, loanable funds theory. Okay, or for argument's sake, Fisher's law. They're the 4 theories that are very key to that topic. Okay, everything else just sort of skirts around those 4 key themes. So for example, this is a pure expectations theory calculation. You might be required to unpack market segmentation theory or expectations theory, something associated. All right. Oh, here we go. We have a theory question. I'm not going to answer this because this will take some time. Is that okay? I can give you some generalities. Okay. There are a number of theories of interest rates, each offering compelling arguments in favour of their propositions. Explain the market segmentation theory of interest rate determination. Okay, so pure expectations theory is frequently your starting point, expectations theory. We then have market segmentation theory. We then have liquidity premium theory, right? That builds upon pure expectations. That tends to be the logical flow of theories. All theories from Nobel Prize winners, so they all warrant our attention. All right. Market segmentation theory is a simple theory of interest rates. What does it seek to do? It seeks to convey that the market has defined segments that actively engage with specific participants. There are people that are more interested in short-term investment, people more interested in medium-term, and people more interested in long-term investment. So there are essentially sub-markets within the broader market. And this gives rise to discontinuities between markets. Those discontinuities are addressed by virtue of some participants riding the yield curve, or bootstrapping for all intents and purposes, engaging with one segment and maintaining a hold position such that they can then engage with a subsequent segment. So they address the discontinuities between each market.
Explain the mechanism of how the market segmentation is done and how it is worked.
This specific theory of interest rates. Do you remember that theory we covered? We covered this week 3. It's a long time ago. I'll concede. We covered this week 3. Okay? Okay. So this semester, obviously, our focus is no longer on Basel II. We have Basel III now being enacted and supported. So this is obviously a question from an earlier version of the course, when Basel II was in effect. But the definitions remain the same, so it's still very, very relevant. So we can still get some benefit from reviewing it now, even if it is a past paper. So let's now consider the Basel Accord. Basel I, Basel II, Basel III, all accounted for different risk concepts and required that capital was held against certain categories of risk. Basel II was one of the first accords to require that risk was held, capital was held, not just against risk-weighted assets, but also to account for operational risk considerations as well. So we are required in this question to define credit risk, operational risk, and market risk as they relate to the Basel Accord. Even if you knew nothing about the Accord, you should still be able to define these. All right? So starting with credit risk is essentially a type of risk that is largely concerned with default and non-payment of a counterparty. So it incorporates counterparty risk and the risk associated with non-payment or non-delivery of a financial position. Okay? That's the simplest way to say it. You can say it briefly, you can use as many words as you want, it's entirely up to you. Operational risk is the risk that seeks to account for people, processes, and organizational functions. For all intents and purposes, it is the risk that emanates from the organization itself, the operations of the entity, and all risk deriving from people and processes within the entity. Key operational risks in the context of the Basel Accord relate to the existence of viable systems and supplementary systems that support the delivery of financial services. But you could just talk about it broadly. Okay, that's the great thing about so many finance problems. Even if you didn't know about the Accord, you could talk about these. All right, market risk as it relates to the Basel Accord. Well, market risk, for all intents and purposes, is the risk deriving from market positions. So positions taken that give rise to an element of market risk, volatility deriving from the market. So the best examples of this would be those positions relating to market-moderated contracts. Interest rate moderated contracts, forex moderated contracts being the most obvious two, but also derivative positions and conditional liabilities. The conditional liabilities thing I wouldn't expect you to know, but that's, if you'd read that section, that would be the perfect answer. All right. So the next question is another theory question, and as I said, people hate theory, and for whatever reason, they don't concern themselves with it enough. But it is important. All right, it is important. During the semester, as I said, often the focus is on understanding the mathematics so much that people disregard the review of theory. But historically, students do well with the calculations and do less well with theory. Some do exceptionally well with both. So there are a large number... Sorry?
What is the word limit like?
You go for it. If you want extra books, you ask for them. All right? As much as you want to write. Till your hand gets sore would be my limit. No, in all honesty, if you responded with concision, that's adequate. No one expects you to write a tome or a volume on a simple concept. It's a 2-hour assessment. It's not a 3-hour assessment model anymore. Okay, we have more progressive assessment during the year now. Okay, so this question asks you about regulation, the financial system regulators, and I'll concede it is a challenging theory question if you're unfamiliar with our markets, without a shadow of a doubt. Okay, if you are, probably not terribly difficult. So the key thing here is making sure that you do that revision. So the RBA, APRA, the ACCC, and ASIC, in the context of our financial system, explain the role of each of the major regulators. So the Reserve Bank of Australia, okay, has 2 key roles. Okay? It implements monetary policy, and it moderates the payment system. I like to describe our regulatory agencies as being dually focused. Each of them has 2 focuses when it comes to the financial services sector. And so the Reserve Bank of Australia is our central bank. It is largely concerned with the moderation and implementation of monetary policy and the moderation and management of the national payment system. That would be sufficient. Okay, students that do know about this obviously write a huge amount talking about the history of the Reserve Bank. It was established in the 70s, post the initial operation of the Commonwealth Bank of Australia as our former central bank of operation. Obviously, you're not really answering the question. You just need to get to the point reasonably quickly. If you want to write all that extra stuff, wonderful. It's great too. All right, APRA is our key prudential regulator. So what is APRA concerned with? APRA is concerned with the prudential standards that are in place in relation to the Australian financial system. Specifically, APRA deals with the Basel Accord and the domestic implementation of the Basel Accord. So what are its two primary focuses? If I was to simplify this into two sentences, I would say APRA is concerned with the adequacy of capital rationing and capital assignment in relation to assets held by financial institutions. One thing. The other key thing that APRA does, APRA is also concerned with the liquidity positions of all banks and ensuring adequate liquidity within each financial institution. As I said, I had the joy of checking that many, many years ago. You were about to ask a question, sorry? Yeah, maintaining the liquidity position. Yeah, that's correct. Yeah. All right. The ACCC is our key competition regulator. So the ACCC regulates banking sector and financial services competition in terms of both disclosure and also the manner with which market participants engage with the market. The other key focus of the ACCC in the context of the banking sector is that they moderate all banking mergers, and they are tasked with the moderation of the four pillars policy, which is a key rule or principle within our banking and securities legislation that precludes our major banks from merging. Two key focuses of the ACCC. Finally, ASIC. Okay? ASIC is our key securities regulator. Okay? So ASIC deals with the creation, sale and exchange of all securities that are created within the Australian financial services system. That's its initial role. Its additional role is in relation to the moderation of market disclosure. Very important ancillary role. That role was, and I should say that set of tasks was vested with or tasked to the ASX. But because the ASX is a private enterprise, several years ago, the government decided that they wanted to change that. And now the ASX, for all intents and purposes, has no real capacity to influence and moderate disclosure. That is dealt with by ASIC. The ASX does have its own proprietary disclosure rules and requirements, but they tend to align to ASIC generally. Okay. Lots of theory questions on this paper. I think it's just because I wanted to put a lot of questions on the paper as a sample. So I grabbed lots of questions from past papers. This is a little bit perhaps longer in terms of the number of questions than you would see, but the paper that you'll see will have multiple parts though. Okay, I'm not going to do question 7. That's a rather basic one that was given for a handful of marks a number of years ago. We'll do question 8 instead. Question 8, briefly describe a bank-accepted bill. Explain the role of the acceptor, payee, drawer, discounters, and other parties in the context of a bank-accepted bill. So how would you go about responding to a theory question like this? I've included this question because bill theory is really, really important, and historically students do find explaining the bill process quite challenging. So, the acceptor in the context of a bank-accepted bill is the party that agrees to pay the face value liability at maturity. That's why it's called a bank-accepted bill, because a bank accepts to pay the face value liability at maturity. They are key to the process. But the process would not be initiated without a drawer. The drawer is the party that initially wants funds, either for themselves or a subsidiary entity. They want to raise money, and they're going to find it difficult to do so through a commercial paper or a one-name paper. They can't do it on their own, so they approach the accepting bank and they request that the bank issues the instrument. Once the bank agrees, the drawer is listed as the drawer to the bill, and they may well also be the payee. The payee is the party that takes receipt of funds when the bill is issued into the market. All right? The party that makes the funds available to the payee initially is the discounter. They're essentially the purchaser of the bill. Okay? They purchase the bill, they discount it in the market if they choose to subsequently on-sign it, or they can hold it to maturity. They could choose to hold it to maturity. Frequently, individuals will hold the instrument to maturity because they are very short-term instruments. But if they choose to rediscount the bill, they will have to endorse the back of that instrument and add themselves to that hierarchy of responsibility. In relation to the obligation to pay the bill's outstanding sum at maturity, the acceptor agrees to pay that liability, but in the event that they don't, the responsibility runs from the acceptor through to the drawer, through to all subsequent endorsers. Okay? All right. That is the bill process. Okay. If you were to describe the bill instrument itself, you could describe it as being a pure discount instrument issued at a discount against its face value, or some iteration on that definition. There are many definitions out there. Just as long as you're representing the discounting process and nature, that will be sufficient. Okay, this next question is beyond the scope of this semester. You'll have an alternative set of theory questions, so I'm not going to dwell perhaps too much on that at this stage. Okay, and if you were to get a question like that, it would be allocated more marks. All right. Question 10. Define the term yield and explain the construction of a yield curve. Identify 3 different types of yield curve. Describe each of these yield curves and draw a fully labeled diagram. Briefly explain the pure expectations theory of interest rates. Okay, so this is a question on yield. I've grabbed these from a number of past papers. Your paper will be more calculative than theory. So this has probably been about 50-50 or 40-60. It's going to be the other way. Okay, so yours will be 60% calculation, 40% theory. But to be honest with you, it's much more important to revise theory. People always find a way when it comes to the maths. They figure out how to learn it. All right. Define the term yield and explain the construction of a yield curve. Identify 3 types of yield curve. So what is yield and what is a yield curve? Very simple concept, sometimes challenging to articulate under exam conditions. Yield is the corpus or excess, the amount earned over and above the amount that you invest in something. Essentially, it's the gain, the net gain amount in relation to a given investment. You can describe it any number of different ways. This is a very broad question. The next part is important, though. How would you describe the construction of a yield curve? A yield curve is a graphical representation or graphical depiction of the relationship between yield and term to maturity. Okay? It represents the yield structure of a particular asset or asset class. You don't have to use the same words as me, but you just need to convey the same sentiment, all right? That's the goal within any exam. Even if you use non-technical language, it's completely fine. All right. What are 3 types of yield curve? Nice and easy one. There's only really 3 options, so. Transitional, yeah. Normal, inverse, and transitional. So a normal curve is one that we describe as positively upward sloping. Inverse, negatively downward sloping, and transitional just moves from positive to negative, or vice versa. Okay? That's the transitional phase. Okay? Alrighty. So you're required to describe each of these and draw a fully labeled diagram. So that's quite straightforward. 3 charts, diagrammatic representation of each. To be frank, that's kind of a gift of a mark really there, isn't it? Just because you've been so lovely over the course of the trimester, if you get a question like that. All right, if you don't, well, there you go. Next question is a slightly more difficult one and certainly indicative of the kind of thing that you could see. Briefly describe pure expectations theory as it relates to interest rates. All right, well, I think this was a question that I just put together quickly just to finish off the sample paper. Normally a question like that would be weighted more heavily. Okay, that's not a 2-mark question. That's something a little bit more involved than that, okay? This is just for the benefit of this sample paper. So pure expectations theory, or quite frequently within your older textbooks, would be described as expectations theory. Okay? Expectations theory. How does expectations theory determine the structure of rates? What is expectations theory? Well, the great thing about so many things in finance is the name says it all. All right, so expectations theory is a theory that asserts that our expectations in relation to interest rates govern the shape and slope of the yield curve. That's your starting point. Okay, if you've gotten that part down, you've gotten something of adequacy down. To explain yourself in the fullest, you would need to also explain the theory in full. So expectations theory asserts that our knowledge of current short-term interest rates and our expectations in relation to future short-term interest rates govern the shape and slope of the yield curve. Do you know what I like to do in an exam? What I used to like to do? Look at how questions are related to one another. All right? You already got a question that covers off on the maths of expectations theory. All right? So you could actually use that example to explain this and get a near perfect response. I mean, that's a perfect explication of the theory. Current short-term rate and expectations in relation to sequential short-term rates governs the shape and slope of the yield curve. Okay, this is where it gets a little bit harder. In a 5-mark question, that would give you 4. To get your final mark, you need to actually explain the underlying assumptions, why it has limitations. Okay? And so what are the limitations or assumptions of expectations theory? That investors have homogeneous expectations, that securities are perfect substitutes, and that there are no transaction costs and market frictions. Okay, there are a few nuanced assumptions, but they're the key assumptions that we would expect. If you write all of that down, you would get your perfect 7 marks. If you write the majority of that down, you'll get 5 of 7. Okay? It is harder to get a full mark, a perfect mark with a theory question, but I'm very, very fair when it comes to assessing theory. Now, I define an upper bound based on a good response range, and that becomes what we consider to be a reasonable response. Okay, no one's ever expected to be perfect. Okay? Wonderful. All right. So look, we finished an entire paper in about half an hour, but I talked through most of it. If we really buckled down, we could have gotten that done in about 15 minutes. That's true of almost everything that you do. I can see that under exam conditions, it's a little bit different. Everything is a little bit different. You have 2 hours. But you should be aiming at getting this paper done in around an hour and a quarter, okay? An hour and a quarter to an hour and a half, and you have that final half an hour to really improve those theory responses. That would be my way to guide you. And as I said, if history is any guide, students that do listen to that, they do well. They get good high HDs. But the cohort, I'll concede, does give rise to some bimodal responses. We get a lot of people around the pass credit range, and we get a lot of HDs. So I want to be very, very clear about that. Okay? So a lot of students do very, very well. They know the material really, really well. They can explicate the response really, really well. There are some students that obviously find the theory more challenging. Okay? The one thing to be mindful of is that you should never be nervous about this paper. It's a paper of generalities, and there is a lot of financial mathematics in it. So if you do that well, you'll always get through. It's just a question of how well you can do. You know, if you're applying for associate programs, these are the grades people will be looking at. Okay? All right, so that's one paper. I might call it a day in terms of our revision for today. So next week, we're going to do a revision lecture in full. So we'll cover off on all the topics up to this week, and we'll do another paper. Okay? Fantastic. So next week, we'll do some structured questions. Please come along with any questions that you have as well. All right. I might also, if it's okay with you all, start emailing through some questions and talking points, just so I can get everyone into that exam mode. I think it really helps to start thinking about things now. So I'll try to keep it to maybe 1 email a week, but it'll just be a couple of things to think about. These are some things that we've covered. Have a think about them now. It's been a little while since we've thought about them, and here is a question to think about. Okay? So you can look out for those. If you don't want to receive my emails, you can send me an unsubscribe link. All right? Or click on, there won't be an unsubscribe there. You can just email me and tell me you don't want them, and then I won't email you. With that said, these next few weeks are the most important ones in the entire program. Even if you've been dawdling or not working terribly hard up to this point, you can still do remarkably well if you're diligent over the course of this next month. All right, so really put the effort in. Reach out if you're having any difficulty with anything. Now's the time. Also, I did mention that I would talk to you briefly about your simulation. There is a PDF that explains what is covered that I will release to you guys. Okay? Obviously, each trimester is a little bit different, so yours will refer to specific topics that relate to yours that are going to be covered. Okay? So this is an example of what you'll receive. But as I said, if history is any guide, it's just a good source of exam preparation. All right. So in terms of what's going to be examined? Yes. No, we're still going to do 2 more lectures. So we'll still do derivatives and we'll still do financial innovation. Okay? But we're going to be doing those sessions in a slightly more expedient way. So we don't cover derivatives in full anymore, because as I said, you guys have the full derivatives unit now. But I do give you guys a lot of material because I think it's an interesting subject and I enjoy it. So even though we're not dedicating as much time to it, effectively it's now half a topic rather than a full topic. Okay? But yes, I'll concede mainly revision from this point onward, mainly revision. Okay? All right, so I'm going to stick around for a few minutes if anyone would like to have a chat about anything, assignment-related, exam-related, subject-related. For those of you that have had your fill, I shall see you all bright and early, same time next week. And look out for my announcements in relation to that Week 11 workshop. Yep. You get that bit? Okay, so total payments multiplied by the payment, right? So the number of payments multiplied by the payment, that gives you all the payments that you made. N is the number of payments that you made. So N is 240. So 240 by that installment payment gives you the total payments that you made over the entire arrangement. No. 240 times the payment that you calculated. Yes. That gives you total payments, and then if you deduct that, it gives you your interest. Because that's your principal, right? The difference between your principal and the amount that you pay has to be your interest. And if you divide it by the number of payments, it's per payment. Yeah, it's pretty simple. How you going? I didn't get a chance to have any extensive conversation with them, but there is a chap who, or a couple of them that I can talk to. Yeah, I do still think that you need to put some time into it yourself. There are some people that are happy to have a quick conversation. I haven't had any extensive conversation with them about you or your circumstances, only because I felt like you disclose that in full. But I've had brief conversations with a few people, and I can pass on their details. So, no, they're more wealth managers. But they're a little less deep in terms of being able to find you opportunities. A business broker will just present you everything they have, like a real estate agent does, and just try to sell you on. So they're often not the best person to deal with directly, unless you're very, very careful about vetting everything. You kind of need someone who will help you review things in my view. Or alternatively, you need to be very, very close to this data. I do know business brokers too, but I have to confess that I don't introduce you to them until you figure out what investment class you want, what you want him to do. And there are people that are probably happy to talk to you for free anyway. So it's just good to get your knowledge of the market up a little bit, and then maybe you can talk to a broker next. I mean, it's not urgent that you do it next month or anything, is it? Or you want to do it very soon? Okay. I can give you the details of the brokers, but I can't vet what they'll be presenting you because I don't know what's in their portfolio. And I do find that their approach is very, very real estate-like. Yeah, but I still think it's worth talking to a wealth manager who might be able to connect you with some good vetted screened opportunities. Does that make sense? Yeah. The broker's not going to screen anything. They're just going to present you everything and say, hope sale buys one, and he's pretty much going to say, look, buy something from my portfolio. He's not going to be referring you to another broker if it's something that's ideal for you. That's my issue with
then they're going to present in their portfolio. It's not a relational model, not a trust model between them and other brokers. So it'll be pretty much, all right, this guy has this, that guy has that, but are they really actually assessing your needs and figuring out what investment you should be investing in? I personally think, Sahil, you're obviously really, really smart. You can figure this out on your own. That could be a good approach, but I just think you have to be really mindful that a broker is not representing you, they're representing their... So if you want me to, I can connect you with them too. Okay? But I know them reasonably well, but as I said, in the process of them engaging in a sale, I don't know how they are still who they are in terms of category. Does that make sense? They're lovely people, but they're still like real estate agents. So, no problem at all. I'll filter those through. I would encourage you, there's a gentleman by the name of Justin Chilwell, who's just a very, very trustworthy, honourable person I have a lot of dealings with. He and there are a couple of others who I rate as very, very, they're very good at what they do, they're very ethical, and they've got good practices. At the very least, they can give you some screened opportunities. I think that's better to start with. Don't make any decision in my view until you've got everything together, and then you can sit down with your team and decide, because my big concern is that if you don't have that original data, if you don't have data room access, you're just going to show me a balance sheet and I'll be like, yeah, okay, it looks impressive, but how do I know it's real? How do I know that those operating statements are real? I mean, I can make some operating statements out of miles with zero, you know what I mean? Like, that's my concern. I'll pass the details on. Okay, give them a call. No problem. There you go. On the final exam? Yes. It'll tell you. It'll list them. In fact, I think this is the same topics, but just different questions. So these are the topics. Yeah. I'll put it online. You're only going to have access from Thursday. From Thursday only.
But this PDF is online.
No, it's not online yet.
And you will re-upload
Yes, most certainly. Yes, I don't know what happened there. Yeah. The sample exam. Yes, that will go live today too. Not all of them, just that one. No problem. See you. No problem. See you guys. Where are you going? Yeah, very similar to that. So these are the question styles. It's very similar, very, very similar though, for all intents and purposes. Yeah, so you will have access to all of this from Thursday onward. From Thursday till the final day of the semester, you have to complete at least one attempt on the test. Yeah.
the news website in the terrorism, you didn't update the slide.
Yeah, I noticed that this morning. I don't know what happened there, so I'll sort that out. I don't know what happened. See you. Yeah. I think this is fine. That's fine. No problem at all. Best of luck. See you. Cheers. Oh yeah, look, I owe you that AI email, so hopefully later today. Yeah, cheers. Looking pretty good. How much time have you got? That's what I was saying, so just try to get it done. I think that you've done pretty well. Just consolidate it now and
a lot of time to prepare all these charts.
who's the unit chair? Munirul? Yeah, okay. Yeah. Try your best. That's all you can do. I think it's going to be more. I think it's fine, and you've done a pretty good job, and there's limited time. And I think you've done well. Don't be too concerned about it now. Make sure you submit something soon. Make sure you typeset it correctly though, because it does seem like there's a lot of material from different places that you've kind of copied across, which is fine. But just make sure you make the necessary changes, to that material. So. Sorry? 11% is not too bad. Should be fine. Don't, all good. That's right. See you. Hi. Actually, do you want me to have a quick look at it afterward? Do you want me to have a quick look at it after? Yeah. All right. So you should wait. If you wait 2 minutes, I'll have a look at it with you after. You can wait in here. It's all good. Yeah. Yep. Okay. Have you been coming to many classes though? Have you? I have an eidetic memory though. I haven't seen you every week. Last 2 weeks you've been coming. Yeah. Yeah. No. Yeah. So I haven't really. So you're going to have to go through it all first because I haven't really seen you here much, which I'm guessing means you probably haven't looked at many lecture notes. Is that true? Really? Okay. So, either way, like, the key thing is to just review the lecture notes. Like, honestly, have you downloaded them all and read them all? Like, you have to be, because, look, I'm here to help you, and so if you're honest with me, it helps me figuring out how you can do well. Because you're not going to get marked down or marked up if you've been coming or not, but it helps me to know how much you've reviewed. So have you read all of the lecture notes? You can be honest. Yeah, so that's the most important starting point. So you have to, if you know them well, you'll be fine. You don't have to read all the textbook. There's lots of books, so you don't have to read the books. There's a lot of pages. There's, 500 pages. You don't have to do that. That's if you want, to have a broader understanding of things, then the textbook is there. But if you can start by going through the lecture notes slide by slide, ticking off, I understand this, I understand this, I understand this, you'll be fine. You'll do fine. You have more than enough time to catch up, more than enough. But you have to make sure you go through the lecture notes and you need to know them well. So everything up to this week is important, okay? So all of the weeks up to this week are very, very important. The next 2 weeks from when they're going to do revision. So it's kind of good. The only problem is if you've not looked at this before and you come to this class today and I'm doing those questions, it seems like, wow, I don't know anything yet. That's how it feels a bit, right? Yeah. So for some people, right, they were doing it very quickly because they, I guess, are probably maybe their work situation allows them to have studied up to this point. Whatever the reason is you haven't been able to, it's okay. You can still catch up. But the next few weeks might feel a little bit like that until you're fully caught up. But you've got 3 weeks. So maybe this week you can do some revision. Next week might still feel a little bit, unknown. But after we've done that revision session as well, you should feel pretty good in the final 2 weeks. So there's enough time to catch up. But you really have to know the lecture notes well, each concept. And do you like the maths side? Is that something that you're good at? Do you like the mathematics, the financial mathematics? You like that part? Well, most of the paper, more than half the paper will be financial mathematics. So if you're comfortable with that, then you'll do really, really well. Did you find the maths easy today? It was very easy, right? Easy enough? Yeah? Yeah, exactly. So after you've done it a few times, there's nothing very, very complicated. There's only maybe 1 or 2 steps to each calculation. So you'll find that once you've done that revision, you'll start to feel much, much better. So download all of that, and you can go from there. Hey, no problem. See you guys. All right. Do you mind if we have a chat outside? Because I think, what's his name? Chewy will be waiting. Is that okay? No, I'll just shut down and I'll come out with you.